Warm welcome to all of you for the pre-scene analysis of SL1 paper. So myself and Indunil will discuss the pre-scene analysis in detail. So over 3 sessions, actually today is the first session of the pre-scene analysis of SL1, right? So we'll be conducting 2 more sessions on 24th November and 27th November, right? As it is mentioned on the screen. So why we are spending 8 hours to analyze the pre-scene is to look at each and every possible important information what is given in the pre-scene, as well as to look at what type of questions, what are the possible questions that can be tested in the unseen based on this particular pre-scene given. So as a value addition, what we do is in the first session, in addition to discussing the case, what is given in the what is issued by the CA Sri Lanka in detail, we actually invited one of the industry expert in the power sector, because if you analyze the pre-scene, if you went through the pre-scene, you would have seen that. So the group is in the process of acquiring or establishing or incorporating a new company in the power sector, which is a specialized sector. You need to have a good understanding about the financial statements, special areas, what is learned to the power sector. For that, we invited Ms. Tanuja Jayawardena. She's a CFA charter holder and working as Vice President Strategy and Investor Relations in Lakdanavi Limited, that is part of the LTL group. So she will join at the latter part of the session today to give you the overview about the power sector as well as to analyze the financial statements. So with that note, so I would like to invite Indunil to start the case analysis with kind of an introduction for the session today. Indunil, hand over to you.
Yeah, thank you, Dasun. Hope I am audible.
Yes, you are.
Right. So, students, first of all, we warmly welcome you. And one thing that you can personally be happy is that you have come this long in your chartered journey, and probably at most of you, I'm sure, waiting to complete 1 or 2 subjects to get your esteemed membership to be a chartered accountant. So this is a key milestone, especially this paper. As all of you know, this has been a challenging paper. As we speak, there are revisions already announced for this paper. Those revisions will be effective from the next year, fortunately, and this is going to be kind of exam prior to that revision. So therefore, having an understanding of the real focus of this paper also with those revisions that's going to come will be important, in the sense that even with the revision that are proposed on this paper is primarily to make this paper not an auditing paper, right? A paper that gives the holistic picture of the business, where when you become a chartered accountant, that you are able to not only interpret numbers, but to connect the strategy, right? Governance, the business risk, and how do you tell that story in financial reporting language. So therefore, this is a very rich subject. And the emphasis is what I just mentioned is, don't think when it comes to the part that I'm talking is 45% of your syllabus. So one of the things that I have seen over the past is that you all are working very hard to do consolidation, all of that, and simply ignore this 45. And believe me, if you take the reason why Dasun and myself doing this session as a holistic detail analysis, you will see the value of analysis at the end about 12 o'clock. You will wonder the level of confidence that you will build and to be ready. So if you balancedly focus on both all the segments of the syllabus, right? Let us say your heart is financial reporting, surrounding that the application of accounting standards, how that can be used to explain the risk of business statement, and then what is the bigger story of the business in terms of non-financial reporting, governance, ethical issue. That's all about this paper. So one advice that I would like to give you before we start case study, whether these questions are going to be tested or not in the exam, irrelevant. The way we analyze this pre-scene from now is a very good opportunity to have 100% syllabus revision in few hours, some of which definitely will be tested. Some of the topics will be tested in the unseen, some may not be tested, but then you are covering those topics. So even in my talk, in this lecture as well as the subsequent lecture, it's a good revision of those 45% of the syllabus. And in Dasun's lecture, it is a very good revision of the consolidation related standards and accounting standards, right? So therefore, make use of that opportunity. So with that, let me share my screen. We'll have, it's very, very important that when it comes to a case study, yeah, I'll share my screen. When it comes to a case study, you should, this is about a story. Can you see my screen?
Yes.
Right. So it's a story. So case analysis, there is an art and science. So the art of case analysis is your ability to interconnect various disintegrated components as one part of the story. And then how do you synthesize? Synthesize is action verb in the exam, right? Synthesize means you are bringing those disconnected pieces together to answer some question that the examiner may ask, right? So therefore, for that purpose, it's very, very important to have a holistic picture. Even in our analysis, both myself and Dasun will connect to whatever aspect. So this issue is probably about strategy. This has to be looked at from financial management angle. This is from a reporting angle. This is from ethical angle. This is from a governance angle. So we are going to give that holistic picture during the first half an hour of this lecture, and then we will deep dive into the issues. So as I say, story really matters. And if you really look at, I invite you to guess, what do you think when examiner give this case study, what company should come to your mind? Be very interactive. Then session becomes, really engaging session. So can you use the chat and say what company is in your mind when you read this case study? Locally and globally? Of course, in this slide, you see some names mentioned. Any guess? Yeah. Cargills. Anyone else other than Cargills? Right. Now, actually, it's not only Cargills. If you look at some of these vision, mission, and some of the strategic areas, we can really see examiner has grown from international cases like Walmart. The Walmart story, again, similar, very similar, right? Food with love is a core of both Cargill's and Walmart if you want to study. So anyway, those are not very relevant, but then it's good to remember those practical companies in your mind when you analyze the case study, right? So now you can go through, for example, look at your case study mission. Mission is the fundamental. Now, this is the story of the case study, right? Now, we are not going to read sentence by sentence the case study. All of you would have read this case study. So we will actually tell that story. Like a story, you will remember that. So now this, every business has to have a fundamental purpose, why they exist, right? Now here, if you read this, the purpose is to serve the rural community of our customers and all other stakeholders through our core business. What's their core business? Food with love. Now you can Google now and see what Walmart wants to do. Is same, right? So core business is food with love, but you can now question that the strategy has changed when they decided to acquire, right, an unrelated business, and they are now going to power sector. All of these strategic issues also you need to remember. But the core business is food with love, and to acquire or to be in other related business. Why? The purpose, they want to reduce the cost of living, enhance the youth skill, bridging the regionality, disparity, right? So by enhancing local and global markets. So if you remember this bigger purpose, if with this bigger purpose in your mind, look at the timeline. Now this is a very quick, very powerful slide of very quickly knowing what happened from the inception. Now Stephen was not very happy with father's business, and 85 you probably wouldn't have born. He started Safeway Holding, right? 85, and then when it comes to after some times he found his friend he really trusts Albert. And you can see even in terms of governance that Stephen and Albert, and not only Stephen and Albert, the Stephen's wife, they are going to play a major role in this business while it's a listed company. So Albert was given 20% stake of one of the major entity, which is the food Fresh Mart that handles supermarket. As the CEO, the 80% is held by the Stephen. And latter part of this case study, they are really extending this business to connect to the core purpose. Remember, radio. Now, if you see this acquisition, how it is revolving around their mission of reducing the cost. Now, you will wonder how, if you read Cargill's annual report, they say the millions that they generated for the poorer, and then how they were able to sell some products at a very challenging price. You see, to facilitate that mission, they started purchasing farming land in rural areas and 4 vegetable farms. Now, you can even now, when you understand the business strategy, you may ask, now agriculture, accounting for agriculture, how this is accounted now like that. That's how all-rounded chartered accountancy start with strategy, the business model, then financial reporting, risk, etc. has to come. So that's what I said is the story, right? So this vegetable farming is really the connectivity with farmers is a bigger part of the story. And then when it comes to in 98, they decided this to be a listed company, right? And also you can see that this listed company is essentially like the main shareholder pumping funds. And they, in addition, they have investment property, and then from financial reporting angle, investment property, even risk of missing statement angle is very important. Now, see, one of the thing, if you go through Cargill's annual report, you will see the investment property risk. Please make a notes. Right now, a lot of companies who had investment property, one of the business risk is most of the business discontinued. So the impairment comes, the fair value can be really a challenge because no business during the COVID and even the economic crisis. But one of the things they say, even in Cargill's case, is that most of the investment properties were occupied by the internal companies, and therefore they were able to continue. So now these aspects are very important when you read this case study. You may want to hear. Now, out of this investment property, to what level it is being held. And also you see the application of leases is big way they are in the balance sheet, right, to use of assets. So these are real application of accounting standards as well, which Dasun will cover. So then when it comes to the next development that 98, under that, they really wanted to focus on related business of acquiring dairy products, confectionery items, right? So those businesses, they started investing. And now this is the period where Stephen's wife, that's Indira, right? She wanted to start the hotel business. And then that was later they acquired a restaurant chain and a franchise, right? Now in 98, another development is there. 99, you can see that they acquired a Coral Beach company, right, in Negombo with a franchise rights of a luxury restaurant, maybe like KFC. Right now, see, when it comes to those, I want to ask you the question. Now, see, in terms of 6 capitals in it, now, see, when I say that, please make another note. Another possible exam topic is integrated reporting and non-financial reporting. Now, these are like intellectual capital and accounting purpose, your intangible assets, how this franchise is accounted, amortized, those things. Now, what I'm trying to say while we talk the case study, you have to connect it to the syllabus in one page. That's why I said this page is powerful. So now 2017 comes a big change. That is where, they are deviating from the mission. Remember that is a very high risk, because when they say food with love and to do operate in a related business, why they want to go with hydropower plant, right? That was started 17, but because of the COVID, it was affected, and 2019, they commissioned it. Today, you should be very happy we have a power sector expert our sector is a very complex sector in terms of financial reporting, the risk, everything, right? And last time we had an interesting session series on the case study on the energy sector. So this is a very specialized area, and you need to definitely know. And very likely in the unseen, you will get that the accounts of this company, right? So then in that you may want to analyze or apply accounting standard and risk, etc. So then 21, another thing that they are saying, they are going to acquire a competitor, that's ExpressMart. And this transaction again was completed 31st March. So it's about a change. Very big point that I want to emphasize is there is a change in strategy. That if you look at their main strategy, I'll cover strategy in the next in another slide. So then this change, I will again explain to you what do you mean by a strategic change and what is the implication of strategic change. Now, as a recap of this story, I invite Dasun to more specifically talk few things about these different legal entities and then how, what different types of business they are covering. Dasun.
Right. Yeah, so I think most of this is explained by Indunil. So the parent company Safeway Holding PLC, so selling branded imported consumer products, and also they have an income from investment properties, which we need to look at under the financial reporting analysis side. So at the latter part of this presentation, and the company has become a listed company in 1998, right? So then the next company that they have started was Safeway Freshmart. So it is actually a supermarket chain with 300 outlets in 25 districts. So the important point in terms of the case is, so they acquired farming lands and set up 4 vegetable farms, which we need to apply LKS 41 agriculture standard to see that how the accounting to be done. So thereafter, so under the acquisition strategy, they wanted to form Safeway manufacturing and distributors, as well as Safeway hotels and restaurants. So these two companies were formed in the purpose of acquiring similar businesses. In terms of the hotel sector, so what is their plan is to acquire loss-making restaurants and hotels, right? So they are this particular matter in terms of the consolidation, goodwill calculation, there can be a scenario of a negative goodwill. So this is called as a bargain purchase, which you need to look at in detail under the consolidation. Actually, the consolidation area should be covered in my next session. Today, the main focus is to analyze the accounting standards other than the consolidation and the segmental reporting. Segmental reporting and the consolidation will be discussed in detail in the next session. And also, as Indunil mentioned, so they built a mini hydropower plant and they have the intention of forming a separate company for that, or they might even acquire a existing power company with a power plant, which you need to analyze in detail. Thereafter, this manufacturing and distribution company acquired or has made 2 acquisitions, fresh milk dairy products and fresh milk confectionery. So the fresh milk dairy products manufacture dairy products. So they even have 50 acres land situated in Kotmale. Then the confectionery company is mainly manufacturing chocolate, right, situated in Siduva. So this is actually part of their acquisition strategy, because what they want is actually a growth through acquisition rather than an organic growth. So then under the hotel sector, this particular group actually acquired a hotel with a restaurant with exclusive global franchise right called Coral Beach Bay Nigambo. And at the latter part of the current financial year, they have acquired a competitor, Express Mars, with 20 outlets in Colombo. So these are the companies which are there or discussed in this case. So these things would be discussed in more detail under the consolidation topic, but for the time being, this explanation would be enough. So Indunil, you can move forward.
Yeah, so basically, with Dasun's explanation, it's registered in your mind. That's why I know there is some repetition, but he gave a lot of additional explanation. For example, loss-making entity. Now, while here we don't, in this session, we don't go to a lot of technicality, but now itself, you know, for example, goodwill, negative goodwill or bargain purchase, called it. So now those things you must make a little note that these are the topics that I will specifically cover. Not to say that other areas you should not study, but these possible to come. So another very big framework that enables you to understand whole case study, if you look at one of the highly powerful non-financial reporting framework around the world right now is IR framework. So please make a note that you may want to study, and even we have already uploaded to revision course some of the powerful sessions where it goes to very detail of IR framework, the GRI frameworks, things like that. So if you can use, I use the chat option. If I ask you in 2 words, how do you explain the IR, right? So if you can practically explain the IR framework, any case study, you can tell like a story. That's such a powerful definition, right? Or explanation. So can anybody try using the chat? Any business story can be explained. Anyone want to give a try? So if you get stuck, so then it's not about memorizing, students. It's about insights. So it is a process, right? Where it is a process founded on integrated thinking. Please write the word integrated thinking. Now look at this case study. They always say food to not only earn profit, but food with love, right? And why they want to reduce regional disparity, for what purpose? Why they are spending millions of money for water purification in their business model? If you go through some of the activities which are practically done, why they are spending such a lot of money to educate kids and the employees, so to educate youth, and that is called triple bottom line thinking. No, please write the word integrated thinking. So IR is founded on integrated thinking, and it tells us the story that how you can use to communicate what. See this word, big word in this case study, you can see the strategy, right? How now this one strategy, second governance, right? Strategy, governance, and then performance. Business has to make money. How strategy, governance, performance, while you perform, you are exposed to risk, and then what is your future outlook looks like. How these pieces create value. Value is not money, but beyond money. So value creation. 2, all these 3 pillars, the economy, environment, and society over short term, medium to long term. Very powerful. Why you want to know this? One is it's a syllabus topic. Second one is a very powerful logical framework for you to absorb the entire case study as a story for you to be powerful. Now see how I just put some of these things to the case study. I said you are connecting, right? The company strategy, why I put vision and mission. Strategy cannot be discussed without a strategic vision and a mission. Strategy has to revolve around it. So this company says this vision is very similar to Walmart vision. Be the destination for customers to save money, no matter how they want to shop. It's all about saving money. And then why they exist, the core business being food with love, and they have 3 pillars to reduce the cost, enhance the youth scale, bridging the regional gap, disparity. Now, how do they do to be successful in the competitive environment? Like Dasun mentioned, their previous strategy from the inception has been acquisition and merger rather than investing in a line of business. However, the exception to this is their power plant, which they are trying to do internally. Remember, one of the directors going to involve in the case study, it explicitly say that. Then I mentioned IR is about how companies' strategy, not only strategy, the governance. The governance will come here below. You will see that how it creates the value. Now, to create value, you need to have input. Now, in this case study, the main financial capital provider is the Safeway Holding PLC. That's the main investor. Case study very clearly say they put money, and you see how their social capital they are building, the uniqueness of networking and partner. All these are from the case study. Yeah, these are extracted from the case study. Networking and partnering with rural farming communities, continuous training and workshop at farms to upgrade the knowledge. So that's they are doing, creating the social capital. They are using these people as a part of their business model. And then there, right side, we can show that capital is going to be increased, the social capital, because they are going to be benefited. And then intellectual, there are a lot being talked about industry for technology, that they are going to, they have IT research department established. They are talking about latest standards on food production, innovation, right? Things like that. And human capital, this young workforce, 5,600, right? And their purpose is to bring affordable and nutritious food to all Sri Lankan. And they have a training institute which is not for profit. So this is all targeting people. And the natural environment is really this farming to everything you need to have. You know, our country is gifted with that natural resources, right? So those are a very important part of the business model. Now, how about governance? Now, there is one big indication given in this case study about the board of directors. I'll cover in a subsequent slide in this in little detail, that so board consists of 12 directors, including 4 directors independent, right? So including 4 independent non-executive directors. So these 12 directors, we may need more information, right? Now, does it mean that 12 minus 4, are they all executive, or are there non-executives who are not independent? Now, if you remember, there is this power sector director who is going to start the power sector. He's an independent, non-executive, but now he's going to start this project. So the moment he gets into that project, he may not be an independent director. He's like another executive person. So we need to, there's another big reason why you should challenge the governance of this company, which I will talk in a little while. Now, I haven't done the right side of this diagram. So what is the story? So IR is about, I said, built on integrated thinking. You have to think. No, reporting is, forget reporting. First, business has to think. Integrated thinking to connect what? Strategy, governance, performance, right? In the context of external environment, using these input as the capital, 6 capitals, how they create value. So the right side shows how their financial increases. So this year, their revenue has dropped. As you know, profit has dropped significantly. There are a lot of risk in the business model coming from external environment. If I go back to the slide, these risks are originating from the external environment. Why their GP is low, what do you know, right? Perhaps one reason is input cost has significantly increased. Now, one of the reasons the case studies is you need to study why profitability is such sensitive to a smaller change in the revenue. That's some analytical perspective to the case study, right? Then social capital, of course, increase. Intellectual capital may be increased. Human capital may have increased. Natural capital, we need to be critical to see whether they have increase or decrease. But this is what they say. You see this, I am asking you a question. How do you connect outcome of 6 capital? This is from Cargill's, right? Now, what are, I want you to think, when they say trusted brand, the top 10 brand in Sri Lanka, brand, is it what capital it comes under? Out of the 6 capital, think about it. Is it human capital, intellectual capital, what? Then all these people, good, I can see students responding. The people development, what capital? Think about it. Now, see, they have achieved 50-50 gender equality. Those are big topics even in governance today. I hope you know EDI. If not, please write. EDI is a big topic in ESG report. What is EDI? Equity, diversity, and inclusion. Then reducing the cost of living. Again, I will ask you what capital? What do you mean by this capital? Cost of living of people. People are going to be happier. Perhaps social capital, right? Enhancing the youth skill and education. If it is targeted internal or external people, you can probably park under social capital. Bridging regional disparity. Again, going beyond the profitability to a different capital like social. Health and safety and affordable nutrition, planet. So planet is certainly about, you know, natural capital. You see they are focused on renewable energy. Now one can argue that maybe the reason they want to go to this power project And already they are talking about carbon footprint, the renewable energy, solar being used aggressively in the supermarkets. So now I spent few minutes not to discuss integrated reporting, but to use integrated reporting framework as a powerful tool for you to remember this case study. If it is coming in the exam, definitely will score very well. So now, of course, during the first half an hour, I will talk more in this case study because I want to build a fantastic connection from governance to risk, and then to financial reporting. That is where I hand over to Dasun to connect from my one, from risk to the financial reporting. So therefore, that connectivity is fantastic. You will see how that connectivity happens during the next half an hour, right, or less than that. This slide is very, very powerful one. Because to be honest, if you compare to last paper where there were several governance topics given, and of course we gave this feedback to Institute that last paper, while the case study was really rich, what is the connectivity with unseen? So we gave a very strong feedback and very sure that this pre-seen, you will see increased alignment if they are to take our feedback positively. So therefore, pre-seen will be very useful for you to remember certain aspects and to connect with the unseen information. Now, you have the case study with you. Of course, when we will give you the page reference, I should have included the page reference here, but you can just control F. The board consists of 12 directors, right? Very limited, only paragraph that is critical for us. All other things are good things, because in a case study, we need to be critical about what issues. So what? Ask the question, so what? The board consists of 12 directors, including 4 independent directors, right? However, the boards of all other companies in the group consist only executive directors. Now, please use the chat and tell me what is the problem. Don't tell this is not the case. Now, you should be able to explain beyond what is given. Now, don't tell the obvious thing. Now, what is the obvious thing? You will ask, why only executive director? That is obvious. No? So, what can be the repercussion, consequence, implication? That is an exam topic, right? And Stephen heads all the boards, including the board of SWH. Can somebody tell me? Obviously, all of you will tell in this company, CEO, chairman split. Can you tell me whether chairman is independent? If not, what is the governance implication? If you can get that answer right, you are a good student. What is the governance implication? Right? All other points are good points, no? Group has put in a place of internal structure with well-defined roles and responsibilities, right? There are board committees, all of that good thing. Governance system demands employees to enhance their competence and capability level to meet higher expectation in managing the resources, higher standards of ethics. Now, please write. Another topic examiner may ask you is the control environment. While this page is corporate governance, from risk of misstatement angle, you can cover this under control environment. It's a hot topic in past papers. Now, when we say control environment, one of the aspects we see is the commitment to competence. Employees are committed. Ethical standards, those are coming under control environment. And they are very happy about the code of conduct, which explain the standards of performance, behavior, professionalism. Then you will wonder why in the same company there is a fraud, where the branch manager colluded with finance staff to claim, right, more than what is required for a repair something. So case study talks in big way about this fraud. So that I will cover in a subsequent slide. When a group has policies and procedures that govern the provision and timely, accurate, complete information. So this is about the information to stakeholders. I want you to write another topic. So you are right in all of this topic. What we mentioned so far, integrated from my angle, the syllabus area under governance and risk. So we spoke about integrated reporting. control environment where you can use the pre-scene to analyze. And now under control environment, you can also talk about information system. And also I want you to write another topic about the board of directors, role of the board. Remember, one new topic in SL1 syllabus, which is not found in corporate governance code or open book, is that what are the 4 roles of the board of directors? I hope if you're a good student, use the chat and say these are the 4 roles of the board, right, in terms of future and the present. So this is one of the important role of the board, and that is accountability. And board of directors, in conjunction with audit committee, is responsible for accuracy and timely publication of information and present in a balanced and understandable assessment. But you will question, if there is such a good audit committee, why there are frauds happening in the organization, right? And then they say board values, the board values the company stakeholders to strive to take their concerns and interest into account when making decisions. So board is following stakeholder approach to governance. Please write, there are 4 approaches, 4 or 5 approaches to governance in your syllabus. One approach is called stakeholder approach. There is a shareholder approach, there is a economic approach, things like that. Now, right side of this slide, you will see some powerful information from exam perspective. One is dominant role of Stephen is a possible governance issue. Let me look at the chat. Board composition is not there. Chairman is not independent. Therefore, majority should be independent directors. Yeah, some of these points are valid, right? So, but you should be able to explain the implication in detail. So, dominant role of the Stephen is very big governance issue. Why? Why we say that? One is did you follow this information from the case study? He gets involved in every decision, right? And he wants to carry out and implement them successfully. He very clearly says, you know, I'm unlike other person where I delegate and monitor, but I want to get involved. Everything, like he comes and involved. Is that a good thing? Whereas that is Stephen's style, the Indira is different. Now, the way she handled the hotel structure, hotel business, restaurant, she consults employee and discuss the issue, solution before acting on them. It's a more consultative approach, whereas this is a more directive approach, say autocratic and bureaucratic approach. She supports the group culture with companies that are under her. You know, don't you see a problem of like a subculture, where there are 2 leadership style at a board level, how it could affect board decision making? Now, as a mature student, this is how you should analyze corporate governance. Not to say board should have X number, or not to memorize and go. But these are very important things that you need to understand, right? Yeah, correct. So governance says no one can dominate. That's why I'm saying now, this information in the case study, you should be able to really explain. The biggest mistake students do is to copy paste from the book, right? The marks you will get when you connect to the information and make sense out of the information. That making sense is the key thing for you to be successful in the exam. Then, additionally, where is the board balance? I already asked this question. If chairman is not independent, the corporate governance code, right? The corporate governance code requires, you know, the majority. See the page number 5, right? If chairman is not independent, non-executive directors should comprise the majority, right? Non-executive directors should comprise the majority, right? More than don't straight go to majority should be independent. The first point is non-executive should be the majority, right? So if we know how the independent directors, 3 or more, all of that thing will come. So these are some of the salient information. And now another big thing is given prominently in this case study is the fraud. Now, not only fraud, they specifically say that while they have a ERP, everything there is a ticket. Now, you can also question that why there is a ticket for everything, can't you build that feature to the ERP, right? So in that sense, is the ERP really integrated with the non-finance module, right? Now, this road, if you look at now, I'm really summarizing this so that you can in a minute remember the case study, right? Outlet manager issue a ticket for breakdown. If there is any breakdown, the outlet manager issue a ticket. Then what happens if I'm a one outlet in say wherever Maradana, say there's a breakdown, so I'm the manager, so I raise a ticket. Manager, engineer, maintenance engineer approve the request. Then email or SMS goes to the service provider and he raises a job card. And now he comes and do the repair. Then what happens? The job is done. When the job is done, he will put, okay, I use X amount of whatever material required. So he will put a claim, no? That this is hours. I spend 5 days to do this repair. So outlet manager again approve the material used and the spent, right? Then the same outlet manager who approves check whether the material used is okay, and the same engineer approves it, right? And then what happens? The job card comes to finance department and the finance process. So their main fraud that happened here, this is the fraud. There is no, this is extracted from the case study. Yeah? Since there is no way to verify the accuracy of information mentioned in the job card, the hours, quantity of material used by the service provider. So we don't know what is the number of days material mentioned. The outlet manager, because there is no independent way of checking, the same people are here who originates check it. In that sense, you need to truly ask, is there a proper SOD? What is SOD? Segregation of duty. True SOD, right? And the outlet manager together with few officers in finance department collude with the service provider. Now see, this big issue, collusion. We know even segregation of duty can fail when there is a room for collusion. And higher cost is mentioned for each job. So each job is inflated and higher claimed. And that may be the reason their cost is very high. So if you look at the administration cost, really increased despite the revenue, look at the numbers, right? Maybe this fraud is really significant, happening over a period. Now, can you use the chat and tell me this is what is in the case study? No. If you are a good analytical student and who has a curious mind, what are the implications of this information to the rest of the information in the case study? I ask you to 1 minute think. Otherwise, we are just talking, you are not thinking. At this level, you must think. 1 minute, use the chat and tell what does this information tells us or regarding how it conflicts with other information in the case study. Let's see, at least one student is able to comment. Yeah, material misstatement over revenue. Okay. Anything else? I want you to connect this to the whole case study. What does it mean? You are saying revenue, whereas this is about a breakdown and expenses and something like that, claiming opportunity to collude. Yeah, maybe you can talk about internal controls are weak. Yeah, so what you are explaining to me is on what is given in the case study, right? I am asking you to integrate this, synthesize. I am texting the action verb of synthesizing now, whereas you are going to extend or implication only you are telling me. So where is the synthesis answer? ඒ කියන්නේ ඔයාලා කතා කරන්නේ මේ දීලා තියෙන දේ ගැන පොඩ්ඩක් එහාට විතරයි. මේක අනික් දේවල් වලට කනෙක්ට් වෙන්නේ කොහොමද? Anyone else? This is real case study skill. Role of audit committee. Very good, Rovini. Yeah. So where is audit committee? Not only audit committee. No. Where is internal audit? Then another big point, if you can talk. Where is so-called ethics? Where is so-called code of conduct? Where the case study talks a lot about code of conduct. Where are those? See this implication now carefully. And the code of conduct. This is why I say code of conduct says promote and strengthen reputation, standard behavior, professionalism. Where is this? Your main, the branch manager, no, the outlet manager, they are the main leaders in the business. If they are colluding, there's a serious question about how ethical behavior is practiced right now. So these are the big flags that I am raising, and you can see how many of you all flag this. Is truly there is a culture of honesty or dishonesty? Like see Volkswagen to all of these companies, what happened? Where is the fraud risk assessment? Have they ever done FRA in terms of those three factors? Examiner may ask you how FRA can be used in terms of incentive, pressure, opportunity, and rationalization and attitude. Then how is the fraud deterrent ability? Isn't there a whistleblowing to indicate such type of event early? Where is the fraud detection capabilities of this company? For example, do you think about a role of analytics? That if you analyze the branch-wise outlet expenses, some branch it's really increasing. That's where the analytics, remember data analytics is a big topic in your syllabus. Analytical procedure or separate chapter, so to speak. And where is the role? Now, one student mentioned audit come. Now, this is the real case analysis. Now, don't just read the case and extend it, but synthesize it. It's a very good example, right? So I hope you learn, and these topics you may want to build some answers around this. Now I'm in another 10 minutes. I'll hand over. As I told you at this part, I will give a proper handover. After that, Dasun will cover rest, and then at the end we have an interesting discussion from Tanuja on the power sector. Now, see this topic, the story behind numbers. So far, we listen to the story, no? Now, you take this to Excel. Do you want analysis? Very simple, no? Few minutes. You're a chartered accountant. This analysis is nothing. See, now did you notice the group of companies, the GP, 13% to 11 drop, right? And not only margin, they are really worried. You see how this little percentage of revenue drop has contributed to a massive drop in profit. So one thing I want to ask you that while there is a significant drop in, while there is a drop in revenue, or that's about 2%, right? Why distribution expenses rising? Why administration expenses rising? Why are the expenses increasing? And why GP margin was reduced? Can we read behind numbers? Okay, let's see the balance sheet also. Drop in profitability, increase in the expense base despite the drop in revenue. Now, did you notice that now this is a global issue? As we speak, the entire globe is, now facing a crisis. If you look at, especially in retail business in Europe, some retailers are holding about 12 billion worth of inventories. Right now, stocks are not moving. But this is slightly a different business. These are not clothing, these are food inventory, but not only food, even in supermarkets, confectionery, there are the now see the demand for chocolates and all. Of course, Dasun is coming from similar industry. He will explain business side of the story in more detail, how business has been impacted. No, you see the inventory turnover has increased, or inventory days increased significantly from 43 to 50, which says that they are accumulating stocks, not moving. Now, a big question to ask what this inventory means. How many locations these inventories? What types of inventories they have? There are maybe sometimes you may want to question where is the agricultural produce, the consumable, in addition to the stocks in supermarkets, right? There are essential things, non-essential things, and they have different other branded items, right? So the debtors, there are collectivity issues as well. So that is why case study prominently at a later stage talks about a cash crunch, right? So they really struggle, and don't forget that this business is significantly using cash. If you do a fraud risk assessment, the opportunity for misstatement is very, very high. So please write another possible exam topic is fraud risk assessment, right? You are recommended to undertake a fraud risk assessment using the fraud triangle. No point of memorizing the triangle if you cannot explain it. Now, see, practically, I'm explaining to you how Cargill has explained this risk, right? Significant level of inventory across broad brand and diversified product range, not one, over many locations. And not only that, the consumers demand judgment. Now we see nowadays we are really thinking, whether to buy this. So when you go to a supermarket, whether you really want to buy chocolates, right? So people are thinking because so high, the cost of living is so high in such an environment that there's a lot of judgment consumers are exercising based on that real categorization of what is obsolete and slow moving is a real hot topic, while inventory standard is basic standard. But for a risk of misstatement, inventory valuation assertion, see, I use the word assertion, the big topic that can be examined, tested. Debtors impairment is a big topic that can be tested. So when you write your answer, you have to say that especially this judgment, now this context you have to write, otherwise you may not get proper marks. And I want you to go to Cargill's annual report and see the key audit matters identified by the auditor. Key audit matter idea is forget the auditor. It is a risk to the business. It is a risk of misstatement, right? So this is a very big thing. So we will, in our subsequent session, we will go into more detail. And now, in another few minutes, I'll hand over to Dasun to extend this discussion. So by looking at overall numbers, right? So 20% of your syllabus, 20, yeah, the risk of misstatement, such a big area. If the examiner gives you this question, please write down, right? Analyze the given information, both in financial and non-financial information to identify risk, 5 risk of misstatement, one question. Another question, right? Evaluate 3 business risks, right? In terms of how they result in risk of misstatement. Those 2 questions, please write. One is directly asking risk of misstatement. Other one is asking business risk and then connect into the annual report. Now, see, for example, you can just go to the, now actually in the Walmart annual report, they have explained this risk in detail, some of these risks. So you can go through that. Maybe in a subsequent session, we will go into detail. So one area is revenue recognition. Why revenue recognition is a big topic for risk of misstatement. One is based on the business model. Now see the word business model. Many types of revenue arising from different transactions. It may be simply selling to consumers. It may be in a restaurant, how sales take place, agricultural produce, how it comes to your P&L, investment property, how your P&L is going to be affected when you fair value model. Did you notice in the balance sheet this year they have done a significant revaluation? Definitely a hot topic. 2 million, not 2 million. This 2,875. So revaluation. A risk of misstatement, inherent risk is very high. Number 1 is a general point. Number 2, in the context of current economic uncertainty, revaluation is really a hot topic. Number 3, you may also want to look at the deferred tax implication, things like that. The inventory valuation, I explained to you already. Receivable impairment. Now you need to really look at SLFRS 9. Is it lifetime impairment or what? So that language you need to really see the rebuttable presumption, and that's where Dasun really connects to my talk how the accounting standards are applied. And then obviously investment property, as already mentioned, investment property is there. Intangible assets, the rights they have, and in addition, the leases, now the new leasing standard, right to use model. Now in the balance sheet, it words like right to use model. And agriculture, obviously, but this agriculture, again, Dasun will take this part, how agriculture can be applied in this case study. So I am sure this is a very good connectivity starting from bigger picture to explain the story, and then numbers, what is behind numbers, and finally, what risk. And now, as experts of accounting standards, how you should interpret this, apply this. So Dasun, over to you.
Okay, so moving into the pre-scene information, what is important for the examination? First of all, it was mentioned, I'm not going to go into the pre-scene, reading pre-scene, because you would have read the pre-scene by now. So whatever the relevant information we'll take here and discuss the accounting implication of this pre-scene information. So the first information what is given is SWH PLC continues its retail shop in Cinnamon Gardens under its direct management and also earns income from its properties. So there are certain properties held by the company which are rented out to the subsidiaries as well as to outsiders. Now, the important aspect that you need to understand here is this particular company is holding properties. If you look at the financial statements even, there are fair value gains that have been recognized with regard to the properties. So what is the important standard that you need to understand here is LKS 40 investment property standard. First of all, you need to understand what is an investment property and the important features of the investment properties. It has to be a property, which means either land, building, or both. And you should either be the owner of the property or else you should have the right of use the particular asset. Either you should be the owner or else at least you need to have the right of use the asset. And most important aspect with regard to the investment properties is the purpose of using the property. So the purpose of using the property should be either rental income or capital appreciation. This is very important. Now, in this particular case study, it was mentioned parent company, that is SWH PLC, hold these properties, and some of these properties are used by the group companies, internal parties, as well as some of the properties are used by external parties. You need to be careful when you are preparing the consolidated financial statements and the individual financial statements of the parent. Now, if you look at the individual financial statements of the parent, all properties, whether it is given to the external people or to the internal group companies, in the company or the individual financial statements, these are to be classified as investment properties, provided it earns a rental income, right? You have given that under a rent. So it's an investment property. But when it comes to the consolidation level, in consolidation, what is the principle? In consolidation, we consider parent and all of its subsidiaries as a one economic unit, one single unit. In the consolidated financial statements, what can happen is the same property, what parent classified as an investment property in the individual financial statements, by giving it to a subsidiary, would become a what? Property, plant, and equipment. What is the reason? What is the reason for that? Because if you look at the group, right? If you look at the group, it own occupies. Because if you have the property, if that particular property is own occupied by you, it is an property, plant, and equipment. It is not an investment property. Now, if you look at the group financial statements, parent company is renting a property to a subsidiary and earning a rental income. If you look at the group perspective, that is own occupied. So in the consolidated financial statement, same property has to be classified as a property, plant, and equipment. So which means accounting treatment, what you have followed at the individual financial statement level, to be changed when it comes to the consolidated financial statements, right? Because in the consolidated financial statements, it seems that this land and building is measured under the revaluation model. So if you look at the financial statements, there are revaluation gains and the losses in terms of the properties, land and building. So what is recorded under the fair value model, you need to change to the revaluation model when it comes to the consolidated financial statements. So revaluation model and the fair value model, the difference between these two is, in the fair value model, you don't record any depreciation. But in the revaluation model, yes, you value the property, but the particular revalued amount you need to depreciate as well. You need to consider these adjustments in case if the investment property area is tested in the examination. Okay. Right. I think I have answer to this question. If parent gives a building for subsidiary for free of charge, not charging any rental income, how would be classify this in the consolidated financial statements? Okay. So then ultimately property controlling by parent, since it should be PP&E when it comes to the group. Yes, so when it comes to the consolidated financial statements, whether if it is given to a group company, right? If it is given to a group company, you can't classify that as an investment property. You have to classify that as a property, plant, and equipment, even though a rent is charged or not. Okay. So at the only in the individual financial statements, you can classify the property as an investment property, right? Moving on, then you need to be careful about the measurement, because this can even lead to a risk of misstatement if you have not applied the correct measurement basis in terms of the investment properties. Because as per the standard, there are two subsequent measurement models for the investment properties. One is cost model, the other one is fair value model. So cost model is similar to property, plant and equipment. You take the cost, you deduct depreciation and impairment losses. But in the case of fair value model, what you do is you fair value the property at the end of the each reporting period, and the fair value gains and the losses are taken to the P&L. And also there is no depreciation recorded under the fair value model. And whatever the model that you have selected, you need to apply either the cost model or the fair value model for all the investment properties that the companies have at the moment, right? So, but in terms of the fair value model, you have one exemption, that is, now sometimes you might not be able to reliably determine in the fair value of a particular investment property. If you can't reliably determine the fair value of the investment property, at that time you are allowed to measure the property at cost. Unless otherwise, if you use the fair value model, you have to measure all the investment properties at fair value, right? So that is with regard to the investment properties. If you have any question, you can ask in terms of the investment properties that can be tested in the unseen as a question relating to an accounting standard. Right, moving on. Then the next information, what is available in the pre-scene, what we need to pay attention is, so this is what is available in the pre-scene. He rewards his loyal employees every year at the annual staff get-together. He means here the Stephen. Stephen does not tolerate any fraudulent activities conducted by the employees. If anything comes to light, he immediately fires the concerned person after settling all dues to the particular staff member. So out of that information, what we can get out? What are the applicable accounting standards here? Number one, it talks about the rewarding the employees. He reward the employees. So the employee rewards. So which means there's a connection to LKS 19 employee benefit standard. And also, as he's firing people immediately, so they can go and file court cases against the company. So which might cause an impact of recognizing a provision or disclosing a contingent liability on the balance sheet. So because of that, with regard to this particular information, what is relevant is actually LKS 19 employment benefit standard and LKS 37 provisions, contingent liabilities and contingent asset part. So what type of employment benefits that you can find out in this particular case scenario given? So these are the all types of employment benefits that we can identify, right? So the post-employment benefits, short-term employee benefits, termination benefits, other long-term employee benefits. Actually, the first four are covered in LKS 19. So employment benefit standard. If you have any employee share-based payments, those are covered in a separate standard that is in SLFRS 2, share-based payment standard. Now, what I want you to understand is in this particular scenario, how these employment benefits are given, or what are the information that is given with regard to these employment benefit in the given case study. Post-employment benefits means after you retire, only employee would get the benefit, not during the employment. They receive, whatever the benefit after you retire, but the company has to recognize the cost of these benefits while they are working for the company, right? While they are working, while they are employing, companies recognize the cost, but the benefit is actually paid to the employee after they retire. So, there are two types of post-employment benefits: defined benefit plans and defined contribution plans. Things like EPF, ETF are defined contribution plans because company's obligation is over once they contribute to a particular fund. But things like gratuity, pensions are coming under defined benefit plans, because here what company has promised is the future benefit paid to the employee. Now, in this particular question, if you look at the statement of comprehensive income, under the other comprehensive income, you have a line item called actuarial gains and the losses, which means definitely this company is having a post-employment benefit plan. It's kind of a defined benefit plan. So that is the applicability of the case study to the post-employment benefit, right? Then obviously short-term employee benefits mean things like, salaries, bonus, wages, what employees entitled during the year of the employment, in the current year of the employment, as well as from the reporting date in 1 year's time. So what is categorized under the short-term employment benefits is whatever the benefits enjoyed by the employee during the current year, as well as from the reporting date in 1 year's time, if you get some benefit that is coming under the short-term employee benefits. Obviously, this particular company, as Indunil mentioned earlier, there are 5,600 employees. So salaries, wages, bonuses paid to these employees to be classified under short-term employment benefits. Termination benefits. So employment termination can happen in two ways. One is it can be a voluntary redundancy. Let's say a company introduce a redundancy scheme. So company can say that, okay, if we are overstaffed, we have automated certain functions so that we need to reduce the number of employees. So anyone who accepts the scheme, we will pay them 12 months salary. So that's a voluntary redundancy scheme. So the employee can accept that. If employee accept, company make the payment. So that is a termination benefit. Because here, the obligating event of the termination benefits is not the employment, but the termination of employment. Because of the termination decision only, company has paid this amount. So that is the difference between the termination benefits and the other employment benefit types. Because other employment benefit types, the obligating event is providing the service to the organization by the employee. But here, obligating event is the decision of termination. And also, these termination benefits can be paid when company fires someone. You are not doing your job properly, or else you are engaging in some fraudulent activities as mentioned in this particular case study. So company decides to terminate your employment. But company would settle whatever the legal dues, and sometimes company might decide to pay something extra and terminate your employment. That is also a termination benefit. Okay, so that is how this particular case relates to the termination benefits. And the fourth one is other long-term employment benefits, which means employees getting the benefit, employees entitled for this benefit even after 1 year. That means if this is actually, I would say, kind of a recycle bin in this particular accounting standard. Why do I say so? If a particular employment benefit is not covered under any of the above, so it has to be categorized under other long-term employment benefits. So things like long service leave. Long service leave means in some organizations, if a particular person or an employee work for number of years, let's say 10 years, you are given 6 months paid leave, 6 months paid leave because of the long service that you have provided to the company. Now the salary cost of that 6 months that the employee is not working, you have to recognize it during the 10 years where the employee is working for the company, not during the 6 months that is not working for the company, right? Long service leave. Then long service awards, as mentioned in this particular case study, because Steven, this particular company is rewarding their loyal, long established employees. So maybe at the 10th years and 10 years anniversary or 15 years anniversary, 20 years anniversary, you give a gift, maybe a gold coin, maybe something which is having much more value than a gold coin. So what you do is you need to recognize that as a long-term employment benefit, and where yet again the cost has to be recognized over the period of time, not at the point where you make that particular payment or give that particular gift. It can be a cash gift. Let's say everyone who is completing for 20 years, company is giving them 2 million worth of cash. So then that cost has to be recognized over the period of they provide the service, not at the time of making the payment. Okay, so now both accounting for both defined benefit plans, which is coming under the post-employment benefits, as well as accounting for the long-term employment benefits are done by using the projected unit credit method. I'm not going to go into detail to explain you what is projected unit credit method. So you follow the projected unit credit method to recognize the employment cost over the period of time. And as I mentioned, so these are the 4 types of employment benefits which are covered in LKS 19. But if you have any employee share-based payments, which is discussed in SLFRS 2, right? In this particular case study, there are no information about employee share-based payments. I hope you understood about it yet again. Right, great. Then what else? What else? As I mentioned, you terminate the employees once they do a fraudulent activity. So what they can do, if they don't agree, because it's your decision, management decision, you believe that they have done something wrong, but they may have the other grounds. They may say that, okay, we haven't. So it's, the termination decision made by the company is not correct. So they can go to the courts. They can take the legal actions. Then what will happen? Company might need to make a provision in the financial statements. So there can be situations, right? You might need to make a provision at the year end. So information can be given in the unseen. So what are the 3 conditions of recognizing a provision? You can't make provisions for anything and everything, right? So always to make a provision. So these 3 conditions are to be satisfied. Number 1, there should be a present obligation. Either it has to be a legal obligation or a constructive obligation as a result of a past event. Very important. Without having a present obligation, you can't make provisions. Then outflow of economic benefits are probable. What do you mean by probable? Probable means more likely than not, which means you have more than 50% chance, more than 50% chance of having that particular outflow, and the amount rupee value can be estimated reliably. So if you are given a scenario in the unseen, before making a provision, you need to check that whether all these 3 conditions of making a provision is satisfied. If so, you have to recognize the provision and make the necessary disclosures. So I'm not going to go into detail to this particular slide because all these things are covered in detail in the theory videos, right? If you can't remember these areas what I discussed, so what you can do is always the detailed explanations are available in the videos, what is available in the LMS, right? With regard to these topics. Now, discussing this thing in bit detail about the present obligation, obligation can be either a legal obligation or a constructive obligation. But in this particular case, it is more or less, it would be a legal obligation, because legal obligation means you breach certain contract, or because of a law or legislation, or because of a court case. Okay, it can be a law, legislation, contract, or a court case. If you have a present obligation, that has to be considered as a legal obligations, right? On the other hand, constructive obligations mean you actually create a valid expectation in the minds of somebody, right? You would undertake certain responsibilities. You will discharge certain responsibilities. You create a valid expectation in the minds of somebody. So because of that, you create a present obligation by yourself. That is actually the constructive obligations. So the constructive obligations can arise because of the established pattern of past practice, published policies, or sufficiently specific current statement. Now, if I take one example, only one, how a published policy can create a constructive obligation. Let's say you are doing your business activities and you announce that you are an environmentally friendly organization. You publish your policy towards the environment in your website, newspaper articles, and your whatever the publications, annual reports, you mention that you are an environmentally friendly entity. Then if you do something wrong to the environment, if you do some damage to the environment, let's say legally you don't have an issue. As per the environmental regulations law, you don't have any issue. That means you don't have a legal obligation. But by publishing policies, you create a valid expectations in the minds of the other people that you would discharge certain responsibilities. So that means you create a present obligation. So that's how the constructive obligations would work. So, but as I mentioned, to this particular question, if employee go to the court case and file a case, so what is important for us is actually the legal obligation side. Okay, right. But you need to understand these percentages, right? So in this standard, you need to, because there are different terminologies are used, because the standard is not only the provisions, it is about the provisions, contingent liabilities and contingent assets, right? So if something is virtually certain, that means virtually certain means 95% of or more, we consider that as virtually certain. If it is the probability of happening something is 95% or more, virtually certain. If probability of happening something is more than 50%, we consider that as probable. But you should understand that is the only terminology out of these four defined in the standard. In LKS 34, the word probable is defined in this way: more likely than not, right? Which means more than 50%. More than 50%. 50% is possible, right? Not probable. Possible means equal or less than 50%. Remote means equal or less than 5%. So other three are actually guidances, okay, industry guidances, but the word probable is specifically defined in the standard. Now, how this is important in terms of the case analysis is, right, how it is important is, you might need to make a decision. Let's say if the examiner say that, okay, there's a court case filed by the employee claiming that it's an unfair termination of the employment. So information would be given in the unseen, then you need to make a decision whether to make a provision or not. Now, if you look at this particular summary table in terms of the liabilities and assets to make the decision, now if something is virtually certain in terms of the liability, what you do? You need to provide. If it is virtually certain, you need to definitely provide, recognize the liability. If asset is virtually certain, you recognize the asset, right? Then we looked at earlier, if a liability is probable, you provide. But if a particular asset is probable, are you providing? No, you just disclose. So this is the prudence concept. So under the prudence, we recognize the liabilities, we recognize the losses. But if it is assets, we are careful about it. With regard to the gains, we are careful about it. Now, if a liability is provided, you need to, if a liability is probable, you need to provide. If an asset is probable, you just disclose. On the other hand, if a liability is possible, what you do? Possible means 50% or less. You just disclose it. If an asset is possible, no disclosure. Again, prudence. If a liability or an asset is remote, even no disclosure. Now, in the case given, maybe given in the unseen, would say that employee has filed the case. Once you ask from the lawyers has given their opinion. So if the lawyer say that, okay, there's 60% chance of losing the case, you need to make a provision. But if the lawyers say that only 30% chance is there for you to lose the case, then you don't need to make a provision. You just need to disclose this as a contingent liability. Making a disclosure means it would become what? Contingent liability. Okay, so a little bit of knowledge about the particular matter was given. If you have any questions from this area, yet again, you can ask. Okay, so there's a question with regard to the long-term employment benefit. I was saying that, okay, if an employee stay for, let's say there can be long service awards. If an employee stay for 20 years, you are given a cash prize of, let's say, 2 million. The question is, okay, how do we know that whether they would stay for 20 years or not? Same thing is applicable for gratuity, right? Same thing is applicable for the pensions. So that's why I said that you have to use the projected unit credit method to to make the provision in terms of the long-term employment benefit. You have to look at the factors, you have to make certain assumptions, judgments, estimates. Based on that, you just make a provision. You look at the past data into account, you look at the current market conditions, then based on that you make a amount provided in each and every year in terms of the particular long-term employment benefit. So there's another question with regard to the virtually certain. Virtually certain means more than or equal or more than 95%. Actually, it is a liability, right? Rather than a provision, you can say that it's a liability. You provide in the sense you recognize the liability. Okay, provide means you recognize the liability. Okay, moving on. Right, so this is one of the important area of the pre-scene. Now we discussed about actually the application of investment property related standard, and also we discussed about the application of LKS 37 provisions, contingent liabilities, contingent assets, as well as how the employment benefit standard would come into play in terms of the information given in the pre-scene. Now let's look at about this important information, because in this particular pre-scene, SWFM, that is Fresh Mart, okay, Safeway Fresh Mart, invested in purchasing farming land in rural areas and set up 4 vegetable farms that cultivate seasonal vegetables with production cycle of 3 to 6 months in Naula, Ampara, Nuwara and Ambilipitiya, 4 areas. Then there's another information, right? The farms have been successful in giving satisfactory harvest continuously. At the end of the financial year, farms will be cleared for replanting. Okay, so this information is given in the pre-scene. Now, you know what is the applicable standard in this particular matter is actually LKS 41 agriculture related standard. Okay. Now, before moving to the straight away move into the answer as per the case, let me give you a brief introduction, in very brief actually, about LKS 41, that is agriculture standard. You should properly understand what it covers in this standard. Okay, what it covers in this standard. So this standard is applicable to these 3 things if they are relating to the agricultural activity. Agricultural activity means there's a management should happen. Okay, so there are people who manage this particular activity, agricultural activity. If you have biological assets, what is biological asset? Living animal or a plant. Okay, biological asset is if there are any biological assets in the agricultural activity, LKS 41 is applicable. Similarly, living animal or plant, example, let's say a cow, sheep, maybe a tree that you grow to take timber out of the tree, right? Fruit tree, biological assets. Then agricultural produce at the point of harvest, very important, agricultural produce at the point of harvest. So there's a connection of this standard to inventory standard, because here this particular standard LKS 41 is applicable to the agricultural produce at the point of harvest. Now, if I take an example of a cow, so what is the agricultural produce that you take out of the cow? Agricultural produce mean harvested product of the entity's biological asset. Milk, right? At the time of milking, okay, harvest is milking the cow. So at that time, now once you take the milk out, you have to account for that. You have to recognize that particular amount of milk. So how to recognize that? What is the standard that is applicable? LKS 41. Because that is an agricultural produce. So as per the standard, actually agricultural produce has to be measured at fair value at the initial recognition, which means you have to calculate the fair value of this milk that you have taken, debit that recognize that as an asset, agricultural produce debit, and where the credit entry goes. Where should I credit? Credit entry, you can't credit the cow, right? So the credit entry has to be passed to the profit and loss statement. You recognize an immediate gain when you recognize the agricultural produce. Similarly, in terms of the plants. So if you look at a mango tree, once you take or pick mangoes out of the tree, you have to recognize the fair value of the mangoes, agricultural produce, right? So you debit the agricultural produce, credit entry goes to the profit and loss statement. Then not only that, now if I go to this particular slide, I can explain this in detail, right? So there are a few examples given, biological asset and what is the agricultural produce produced by using this biological asset, as well as what is the product that you process this particular biological asset and convert it to what. Now, if you look at the dairy cattle, that is the biological asset. What is the agricultural produce? Milk. Now, dairy cattle is a biological asset. What is the applicable standard? LKS 41. How to account the cattle is covered in LKS 41. Then at the time of milking, taking the milk out from the cow, at that time, at the point of harvest, yet again LKS 41 is applicable. At the point of harvest, LKS 41 is applicable. Then after the point of the harvest, let's say this particular milk that you keep to sell as it is a milk, or else you process this milk and produce some other product, maybe cheese, maybe yogurt, maybe butter. So after the point of the harvest, same milk, once you keep that for trading or once you keep that for further processing, would become what? Inventory. So as per the standard, what is the applicable standard for the inventory? LKS2 inventory standard. Right? So the agricultural produce you recognize as an inventory later on. Now for the inventory recognition purpose, we learned that in LKS2 inventory has to be initially measured at cost. What is the cost? Now think about this particular example, milk. What is the cost? There's no cost incurred, right? In monetary terms. So the whatever the fair value less cost to sell that you measure the agricultural produce initially, right? Whatever the fair value less cost to sell that you have recognized, that you measure the milk initially, would become the cost for the inventory valuation purpose. Initial measurement of the inventory is the same fair value what we have measured the agricultural produce, right? That would become the deemed cost. Thereafter, you apply the inventory standard, which means inventory has to be measured cost or NRV, whichever is lower. That is the subsequent measurement of inventory, right? So that is common for all these examples. Now, if you look at a sheep, the particular agricultural produce is the wool that you take, right? You take wool out of the sheep. Then so at the point of the harvest, yet again, how to account the sheep is covered in LKS 41. And at the point of the harvest of this wool out of the sheep, LKS 41 is applicable, but this wool would be processed to produce yarn or carpet, where the applicable standard would be LKS 2, right? Then if you look at some plants, trees in a plantation forest, you grow timber trees to take timber out of these trees. These trees are biological assets. LKS 41 is applicable. Then what is the agricultural produce out of these trees? Fell trees. Harvest means you cut down the trees. So the fell trees are the agricultural produce. At that time, at the point of harvest, 41 is applicable. And thereafter, you use these felled trees to produce logs or lumber. It would become inventory. Okay. Two more examples. Grapevines. Grapevines are used to produce grapes. So the particular grapevine is a biological asset. Then the grapes, once you pick these grapes, okay, so the grapevine is a biological asset. So the picked grapes would become the agricultural produce, and thereafter it would be classified as inventory. It will be further processed to produce wine. Finally, fruit tree is a biological asset. Then the agricultural produce would be the picked fruit. At the point of harvest, you apply LKS 41. After that, the initially measured amount of fair value less cost to sell would become the cost of the inventory. Then it would be accounted as inventory. By using the picked fruit, you produce processed fruit. Now, with regard to these trees, you need to be a bit careful, right? Even though these two are biological assets, actually because when it comes to the plants, right, this is a very important point. When it comes to the plants, you need to classify them into either bearer plants or consumable plants. There are two types. Okay, what are these two? You would say that it can be either a bearer plant or a consumable plant, especially in terms of the plant, right? What is bearer plant? Bearer plant mean that produce the agricultural produce for more than one time. Now, if you look at the fruit tree, that let's say it's a mango tree. It produces mango for more than one time, many number of years. Similarly, grape vine will produce grapes for many number of times, right? So that is a bearer plant, right? That is a bearer plant. Then what you need to do is, these bearer plants are actually accounted as a property plant and equipment. It's like a machinery, right? Because you produce agricultural produce many times. So this is actually under LKA's 16 property plant and equipment. They has to be accounted as a property plant and equipment. Is that clear? Right? It's a biological asset, but it's a property plant and equipment. But the unharvested produce of the bearer plant. Now let's say in this fruit tree, mango tree is a PP&E. There are mango on that particular tree which you not yet harvested. Those mango is considered as a biological assets. Unharvested produce of the bearer plant, how to account for that is covered under LKS 41, but the bearer plant is accounted under LKS 16 PP&E. You can either measure that under cost model, or else you can measure that under the revaluation model. But on the other hand, consumable plants, the best example is this: trees that you grow to take timber out of these trees, right? Let's say teak tree, mahogany tree. Why you grow these things? To take timber. You consume the plant itself. That is a what? Consumable plant. Consumable plant. So the consumable plants are covered under LKS 41. That is a biological asset itself. You have to apply the measurement principles in LKS 41. That means measurement principle in LKS 41 is the fair value less cost to sell. I hope you understood about it, right? Because this is important for you to analyze and understand, okay, how are you going to account for the given scenario in the case study? Is that clear? Right. Okay, I hope you are clear about it, right? I hope you are clear about it. With that knowledge, if I go back, so I told you this particular standard is applicable for LKS 41 is applicable for the biological asset. Now you know what is a biological asset, but certain biological assets, especially bearer plants, are not measured under LKS 41. It is classified as a property plant and equipment, right? So then the agricultural produce at the point of harvest, yet again this standard is applicable, as well as if you have any government grants relating to biological assets, only relating to what? Biological assets that are measured at fair value. Okay. Now there's a separate standard to account for the government grants. What is it? LKS 20, accounting for the government grants and disclosure of government assistance. But if you receive a government grant in relation to a biological asset, and that particular biological asset is measured at fair value, then LKS 41 accounting is applicable. There can be a scenario you receive a government grant in relation to a biological asset, but the biological asset is not measured at fair value, because there are certain instances, if you can't reliably determine in the fair value of a biological asset, you measure the biological asset at cost model, by using the cost model. If the biological asset is measured under the cost model, then you receive a government grant in relation to that particular biological asset. Applicable standard is LKS 20, not LKS 41. So to make it to LKS 41, it has to be a biological asset, and also that has to be measured by using the fair value, right? So that is the scope of the standard for what LKS 41 is applicable. Okay. Then again, before we move to the specific scenario in this case study, you should also know that for what this standard is not applicable, even though they are relating to the agricultural activity. There's a management happening in terms of the agricultural activity, but they are not considered as items in the scope of LKS 41. What are the examples? Obviously, land relating to agricultural activity. Now, this particular company have some farming lands. So they use this farming lands to grow vegetables, right? Now the particular land on which these vegetables are growing are not considered under the LKS 41, because land is a property, plant and equipment. You need to apply LKS 16 property, plant and equipment standard. Hope you are clear about that. Then there can be certain intangible assets which are used in this particular agricultural activity. Maybe if you are given a license or something to carry out the activity, and there's a cost to get that particular license. In developed countries, we have, license for the shipping, fishing, sorry, not shipping, fishing quotas, license for the fishing quotas. You have to get a license to carry out the fishing activity. So similarly, let's say to carry out this agricultural activity, you need to get a license or something which incur a cost. So that is a what? Intangible asset. Yet again, accounting for that particular intangible asset is not covered by LKS 41. It is covered in LKS 38 intangible asset standard. You need to apply the intangible asset standard. Then I already told you, this is very important point, agricultural produce after the harvest. Once you take the milk at the time of the harvest, milk taking the cow, that is what? Agricultural produce under LKS 41. Then you keep that milk for trading purpose or to further processing, then it would become what? Inventory. So the applicable standard would be LKS 2. Then I already explained to you, if you have bearer plants which produce agricultural produce for more than one period, examples would be fruit tree, mango tree. Example would be another example would be a grape vine that produce grapes many number of years. Another example would be a tea bush that produce tea leaves many times. These are bearer plants. So these bearer plants are to be accounted under LKS 16 property, plant and equipment standard. But however, any unharvested produce growing on a bearer plant, unpicked mangoes on a mango tree, unpicked grapes on a grapevine, those are, such as grapes on a grapevine, is a what? Biological asset. So it has to be accounted under LKS 41. Right? Are we clear? I hope you understood up to now. Now, also the standard says something like this. What is this? Annual crops. So the examples, what is given in the standard is wheat and maize. Maize means corn. In our context, we call that as corn. So these are annual crops. Every year you need to grow. Every year you need to grow. Then you need to clear the land and again you need to grow. So now these annual crops are not bearer plants, right? That you understood. Why? Bearer plant means what? Something which produce agricultural produce for more than one period. But when it comes to annual crops, it's not the case. You produce, wheat or corn once, thereafter you have to remove that and again you need to replant it. Now in this example, what you have been given was what? Vegetables, right? What you have been given was vegetables. Now if you look at vegetables here, so this particular company, Freshmart, Safeway Freshmart, investing in farming land. Now, can I ask a question? How to account for this land? Is it as per LKS 41? Farming land? Answer to the question. Now, if you understood, you can answer to the question. Hurry up quickly. We have a lot to do. Okay, LKS 16, property, plant and equipment. Great. So company has invested in purchasing farmer lands in rural areas and set up 4 vegetable farms. They have undertaken certain agricultural activity. Okay, so there's a management happening. It's not just growing. So the meaning of, what is the meaning of agricultural activity, by the way? I forgot to ask. Sorry, I forgot to ask. What is the meaning of this agricultural activity? There's a management. Okay, somebody managed the, this particular biological assets growth or the change. Now, let's say if it's just a forest, nobody is taking care of it. It's just growing. Trees are just growing. No management activity. Then it's not a agricultural activity. Agricultural activity means there should be some form of management. Now here in this particular example, so company definitely manage these 4 vegetable plants. They are not just growing. So there's an agricultural activity, right? So the company has purchased lands in rural areas and set up 4 vegetable farms that cultivate seasonal vegetables. with production cycles of 3 to 6 months. It's kind of what? Seasonal crop, annual crop. So then is it a bearer plant? It's not a bearer plant. So if it is not a bearer plant, that means you are not going to account that under, because if it is a bearer plant, it has to be accounted as a property, plant and equipment. So annual crop, seasonal crops like vegetables are not a bearer plant, so that you need to apply LKS 41 to account these particular plants or the vegetables, right? So now what happens is you grow these vegetables, then you harvest those. When you harvest, that creates a what? Agricultural produce. Let's say you grow vegetables and you harvest it, and at the time of harvest, it creates what? Agricultural produce. Immediately, when the agricultural produce is produced, you need to measure that at fair value. Fair value less cost to sell. What is the measurement basis discussed in the standard? Fair value less cost to sell. You have to measure that at fair value less cost to sell. So debit entry goes to the agricultural produce, credit entry immediately you take to the profit and loss statement. Then this agricultural produce, if you keep for trading or for the processing, would become inventory. Okay, right. Farms have been successful in giving satisfactory harvest continuously. At the financial year end, farms will be cleared for the replanting. Okay, so always remember the measurement base is discussed in this standard. Measurement base is discussed in this standard for the biological assets as well as for the agricultural produce is the fair value less cost to sell. What do you mean by less cost to sell? If you need to incur any commissions, brokerages to sell the particular biological asset, that has to be deducted. Selling cost has to be deducted. Now, if you look at the biological assets at the initial recognition, as well as at the end of the each reporting period, you need to measure the biological asset at fair value less cost to sell, and the fair value less cost to sell changes you need to take to the profit and loss statement. You need to take to the profit and loss statement, right? But sometimes biological assets, you might not be able to determine the reliable fair value straight away. Now, good example what I can give you is the nursery plants. What do you mean by nursery plants? Plants which are at the very early stage. You just have it. Very small plants. You can't determine in the fair value reliably. So up until you can reliably determine in the fair value, you measure them at cost less depreciation. As soon as you can measure them at fair value, you change the measurement basis to fair value less cost to sell, right? On the other hand, that is about the biological assets, initial recognition at as well as at the end of each reporting period, it is measured at fair value less cost to sell. But if you can't reliably determine in the fair value, you measure that at cost less depreciation up until you can reliably measure the fair value less cost to sell. But in certain questions, examiner might not give you any information about the selling cost. So, or else he might say that selling cost is negligible, right? Selling cost is negligible. So there you can ignore the selling cost and measure the particular biological asset or the agricultural produce just at fair value. Okay. Then about the agricultural produce at the time of initial recognition, again, I'm reminding you, LKS 41 is applicable for the agricultural produce at the point of harvest only. At the point of harvest, you recognize it and you pass this entry. What is the entry? Agriculture produce debit. You put a value and you credit that to the profit and loss. Right? Then this amount what you recognized over here would be the initial cost for the inventory valuation. This is the deemed cost for the inventory valuation. Subsequently, inventory has to be measured. This is the cost. Subsequently, inventory has to be measured at cost or NRV, whichever is lower that you know. Are we clear? Okay, so so this is about the recognition and the recognition of gains and the losses. Once you initially recognize the biological assets, you measure that at fair value less cost to sell. Subsequently, also you measure that at fair value less cost to sell. So the fair value gains and the losses you take to the profit and loss. Right? Now, good example of recognizing a gain in relation to initial recognition of a biological asset. Let's take this example. Let's say there's a cow. That particular cow has given the birth to another calf, small cow. Calf means small cow, right? That's the initial calf is the initial recognition of the biological asset. What you need to do? You have to fair value the calf, debit as a biological asset, credit entry goes to the P&L, right? That's how the biological assets initial recognition results profit and losses. Actually, it's a profit. Initial recognition of that particular biological asset calf amount into a profit to be recognized in the P&L. Okay. So agricultural produce, I have explained to you gains, gain or loss. Actually, again, it's a gain or loss on the initial recognition at fair value less cost of sale to be included in the P&L for the period in which it arises, right? Okay. Okay, so there's a question. Okay, so what now? Let's say I told you biological assets are measured at fair value less cost of sale, right? But the question is, if we initially measure the biological asset at costless depreciation because you can't reliably determine the fair value, how are you going to do that? Now, what you do is you, up until you can measure the reliable fair value, you take your carrying value cost minus the depreciation. Depreciation is depending on the useful life. Then you have a carrying value. No? Now, let's assume you have a carrying value of 100 of a particular biological asset. Now, today, that is cost minus the depreciation. Now, today, you realize that, okay, you can measure the fair value. Now, the fair value is 120. You recognize a profit of 20. That's it, right? So you don't need to make any retrospective adjustments, right? Last year, you would have recognized the depreciation. You don't need to change that. So it's a prospective adjustment. So in the year where you can measure the fair value, you convert that into the fair value and recognize the gain or loss in the particular year. I hope you understood about it, right? Okay. Right. So with regard to biological asset, that's what I wanted to explain to you, because in this particular question, there's a information given in terms of this vegetable farms, right? And under the unseen, you can, examiner can elaborate this and ask a question relating to LKS 41 agriculture standard, where you should know in and out. Yet again, I'm telling you, I am discussing only a brief here. If you understood, that's great. But if you don't understand, you need to go back and watch the relevant video in relation to these areas, right? Because we can't spend a lot of time, right? Here, spending 8 hours is also a lot of time to analyze the present, because as I mentioned at the very beginning, this is the first session and there would be 2 follow-up sessions. So the next session would be done by Indunil on 24th, right? That is Thursday, 7 p.m. to 9 p.m. Then the follow-up session with regard to the financial reporting, that is mainly covering the consolidation areas and the segmental reporting, I'll be doing on next Sunday at the same time, 9 a.m. to 12 noon. Okay. Right. So there are a lot to discuss in terms of the accounting standards, but as you are listening for a long time, what we can do is we can have a 10 minutes break. After 10 minutes break, we'll discuss back again, especially so we are taking this power sector financial statements, and there's an expert who is working in that particular sector, discuss about the power sector financials. That part also we'll cover after the break. So I'll see you in 10 minutes, right? If you have any questions during the break, you can ask it by using the chat box. Yeah, right. Hope you are back. Let's continue. Now, this concept of fair value is important because even if you look at the previous standard that we discussed in LKS 41, you need to measure the biological assets at fair value less cost of sale. Agricultural produce, fair value less cost of sale. So it's a important concept, right? Not only that, actually, there are many standards which requires different items to be measured at fair value. We look at the examples in this particular case, right? Where the items are to be measured at fair value, because we have already discussed few scenarios, right? One is, please kindly keep your mics muted. It seems that somebody's mic is on. Right, okay. So we looked at actually scenarios where the investment properties that has to be measured at fair value, companies using the fair value model, right? We discussed land and building is measured at revaluation. So which means fair valuation is required. Now different standard requires items to be measured at fair value, right? But how to measure the fair value, how to calculate the fair value is guided by a single source, that is SLFRS 13 fair value measurement standard. So first of all, this standard actually defines the concept fair value, right? So it defines the concept fair value, price that would be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at measurement date. So this is actually the exit price. What do you mean by exit price? If I have an asset, at what price I can sell the asset? If I have a liability, how much should I pay to transfer that liability to someone else, right? Exit price in an orderly transaction, arm's length transaction between market participants. Okay, that means no relationship. Market participants mean buyers and the sellers. There's no relationship between them. Okay, market participants at the measurement date. So the measurement date can be either the initial measurement of an item or a subsequent measurement of an item. So this is how the fair value is defined. This is actually a market-based concept, not an entity-specific concept. That means you need to look at when you fair value something from the eye point or the viewpoint of a market participants, not in relation to your organization. Okay, how a market participant would look at the thing. So you calculate the fair value from their angle. So when you determine in the fair value, use observable data from active markets wherever possible. What do you mean by observable data? Not entity specific data. If a particular data, let's say cash flow forecast, is available only for the organization that prepares the particular information, that is entity specific data. Observable data means it is available to all the market participants. And also, when you measure the value of an item, as much as possible, when you have active market, use it. Now, for an example, stock exchange, Colombo Stock Exchange is an active market. So the shares are getting traded in the listed companies. Frequent transactions are happening, right? Okay. So again, this is only a summary, not going to go through the entire thing. So when you are fair valuing, it can be a standalone asset. It can be a property, plant and equipment. It can be a financial asset, right? It can be a investment property, or sometimes it can be a group of assets like a cash generating unit or the entire business. Then for the fair valuation, you use different techniques. Like there are three techniques actually you can use. One is market approach. After discussing this, theory, summary of the theory, I'll come to the areas where this valuation is important in the given financial statements of this particular company, right? So give me, a small time to elaborate these areas, and thereafter straight away look at what items are relevant in terms of this particular case to the fair valuation. Okay, market approach, that means three techniques. Okay, three approaches to measure the fair value. Number one, market approach, which means you look at the recent market transactions. You look at the recent market transactions, and based on the prices of these market transactions, and you value the item. Income approach means you take the present value of future cash flows and measure the item. Cost approach means you look at the replacement cost. If you want to put up a similar item, how much of cost it would incur? That is the fair value. cost approach. And the inputs that you use in these three techniques can either be observable input or it can be unobservable input. Observable means what? It can be observable by all the market participants. Unobservable means it is not observable to the market participants. It is only for you, entity specific. So out of these two, what is better? Always try to use the what? Observable inputs as much as possible. Okay, so in whatever the valuation technique, so the selection of the valuation technique is depending on the item that you fair value, but whatever the valuation technique, try to use observable inputs as mentioned earlier and active markets wherever possible. Now, even with regard to the biological assets, what we discussed earlier, you have to remember these things when you are measuring the fair value, right? Even for the investment properties, you need to remember this. Even for the property, plant and equipment, you need to remember this. Then in the standard, one of the important area that is discussed is actually the fair value hierarchy. You need to follow the hierarchy when you use these valuation techniques. I told you there are three valuation techniques, three methods that you can use to measure the fair value. Whatever the valuation technique, you need to follow this hierarchy. So the hierarchy in the sense, so this hierarchy is decided depending on the level of inputs that you use for the fair valuation. So there are three levels of inputs: level 1 inputs, level 2 inputs, and level 3 inputs. So what you look at first is whether the level 1 inputs are available. Level 1 inputs means three things. It has to be a quoted price, identical asset in an active market. Best example is if you have shares in a listed company. Let's say I have shares in Hemas Holdings, right? So I need to fair value this shares investment what I have. I have what? Quoted prices. For identical asset, my shares and somebody else's shares which are getting traded are identical. Market is active, frequent transactions are happening. I can use the what? Level 1 inputs. So when you have the level 1 inputs, you must use the level 1 inputs. You can't go for level 2 when you have level 1 inputs. That is what is meant by hierarchy. Okay. Then level 2 inputs mean these are, you go for level 2 inputs only if you don't have the level 1 inputs, right? Otherwise you can't go for level 2. Level 2 inputs are observable prices, but they are not level 1 inputs. That means you don't have all these three characteristics. To classify as level 1, you need to have all three. But here, you don't have all three, but they are observable prices. Example, quoted prices for what? Similar asset, not identical asset in an active market. Okay, quoted prices, active market, but not an identical asset, similar asset. Or else quoted prices for identical asset in a less active market, level 2. Or else it can be any observable input which is not a price. Example, let's say market interest rates, price earnings ratio of a listed company. So these are what? Observable input which are not the prices, right? So example what I can give you for the level 2 input is, let's say if you need to value a property in Colombo, you would consider the recent market transactions in similar area for similar properties. You look at what is the square meter price of the property in that particular area. So based on that price, you value the particular property that you want to value. So that is, you are using the level 2 inputs to measure the value of the particular property. Are we clear? Right. Level 3 inputs mean lowest quality. You go for level 3 only if you have level 1 or if you don't have level 1, you go for level 2. If you don't have level 2 even, you go for level 3. So possible exam question, or actually popular type of an exam question by the examiner is companies using level 3 inputs while they have level 1 and level 2 inputs. That is not possible. In the question, it can be mentioned saying that, okay, management believe that this is the best method of deriving the fair value and the fair values derived in the past is compatible. And they justify using the level 3 inputs. But I told you the standard is fair value concept is looked at from a market participant's point of view, not entity specific. Okay, you have to look at not what is good for the entity, not what is accurate to the entity. If you are a market participant, how do you measure the value of the item? Are we clear? So our level 3 inputs are unobservable, entity specific, market participants can't see. This could be example, let's say you need to measure the value of a particular unit, business. So what you do is you prepare a cash flow forecast. So that particular cash flow forecast is not available to the market participants. You make the assumptions about future volume growth. You make the assumption about cost increases. You select the discounting factor. You say, okay, these are the assumptions. You know about this and might be precise, but unfortunately it is unobservable to the market participants, right? So these are the 3 examples what I have explained. I think you can go through. I explain about it, level 1, level 2, and level 3 inputs, and the example is given in the particular slide where you can go through. Right. So now you need to tell me, right? You have basically you have gone through the case study. Yet again, I believe that now there are certain areas which we already looked at. The concept of fair value is applicable. Summarizing, starting from the first point, if I go back a bit from the point where I started about the analysis of the financial reporting aspects. So first of all, we discussed about the investment property standard, LKS 40. There's a subsequent measurement model, value model. So that means how to fair value a investment property, how to fair value part to be done as per SLFRS 13. Okay, SLFRS 13 doesn't discuss about what items needs to be measured at fair value, right? What item need to be measured at fair value is discussed in those separate standard. So the role of SLFRS 13 is when a particular standard requires an item to be measured at fair value, how to fair value is guided by SLFRS 13, right? Okay, so one thing is value model in investment property standard. I told you this particular entity, if you look at the case, their financial statements, they have a fair value gain of the investment property. That is because the particular property is fair valued at the end of each year and the value changes are taken to the profit and loss, right? Unrealized value gains and losses are taken to the profit and loss. So that is one example. Then here we don't have any examples for the fair valuations. Okay, by the way, I forgot to ask, how do you measure the provisions? What is the measurement basis of provisions? Cost? Fair value? Can you tell me? At that time, I forgot to ask actually. What is the measurement basis of provision? Put your answer in the chat box, please. What is the, how do you measure the provisions? You are nearly there, not reliable estimate. So what is mentioned is reliable estimate, not the word reliable. What is there in the standard? It has to be the, okay, so there's another answer, fair value in the probabilities, it is factored. Okay, it has to be measured at best estimate, remember, because provision is a liability uncertain in timing and amount. How a provision is different from the other liabilities? Provision is a liability, it's a liability, but uncertain in either amount or timing or both. Because of that, always provisions are measured, always in the sense, initially as well as subsequently at the end of each reporting period, you measure the provisions at the best estimate. Okay, not at fair value, not at cost. Okay, moving on. Simple stuff. Then here we discussed both biological assets and the agricultural produce. Biological assets initially as well as subsequently measured at fair value. Agricultural produce at the point of harvest, you measure it at fair value less cost to sell. Always in the biological asset, always in this LKS 41 agriculture standard, fair value less cost to sell. Even though I say fair value, it is actually in this standard always fair value less cost to sell. But sometimes examiner might say that selling cost is negligible, or he might not give you the information about the selling cost. Then you can say that, you can assume that selling cost is negligible, or you just need to measure the item at fair value, right? Okay, now it's your turn. Tell me, by looking at the financial statements of this entity, what else, what items other than what we discussed above to be measured at fair value? Hurry up, quickly. Hurry up, quickly. You don't answer. Nothing. Nothing. You have some financial assets, right? You have some financial asset on the balance sheet. Okay, so those financial assets, equity financial assets, are to be measured at fair value, and certain debt financial assets are also to be measured at fair value. Okay, so when you have financial assets, you either classify that as a debt instrument or equity instrument. If it is an equity instrument, definitely at fair value, either fair value less cost to sell or fair value. Sorry, if it is an equity financial asset, equity instrument, either it has to be measured at fair value through profit and loss, fair value through profit and loss, right? Or else fair value through other comprehensive income. But if it is a debt financial asset, either you measure it at amortized cost or fair value through OCI or fair value through P&L, right? So that is one instance. In addition to that, we already discussed about this one, revaluation. So subsequent measurement of PP&E. In this particular question, it specifically mentioned land and buildings are revalued. So there is a huge amount of revaluation gain given in the current year. Okay, so huge amount of revaluation gain given in the current year. So you have two subsequent measurement models in terms of the PP&E, either cost model or the revaluation model. Cost model means cost minus depreciation minus impairment losses. Revaluation model means you revalue the item. But the difference between the revaluation of PP&E and the fair valuation of the investment properties is there are two differences. Number one, revaluation gains are recorded in the other comprehensive income. Through that, it goes to a equity reserve called revaluation reserve. Through OCI, it goes to equity reserve. But when you fair value the investment properties, fair valuation of the investment properties results, gains and the losses, unrealized gains and the losses, those are taken to the P&L. On the other hand, when you revalue a particular PP&E item, that revalued amount you need to depreciate over the remaining useful life. So revalued amount has to be depreciated. But when it comes to the fair value model of the investment properties, there's nothing called depreciation. You don't depreciate. So those are the two differences between the revaluation model and the revaluation model of PP&E and the investment property valuation model. On the other hand, it seems that in this particular question, there are certain equity financial assets appear on the balance sheet, as well as if you look at the other comprehensive income, there's a small amount of fair value changes recorded under the other comprehensive income. So if I invest in an equity financial asset, you can put that under either fair value through profit and loss, which means you fair value and the fair value changes are taken to the P&L, or else you can put that under the fair value through other comprehensive income. That means you fair value and the fair value changes are taken to the other comprehensive income, and that amount recorded in the other comprehensive income is getting accumulated in a separate equity reserve on the balance sheet. Now, when you invest in a equity financial asset, when you buy shares of a company, it can be a listed company's share, it can be a private company's share. Normal expectation is to measure or to categorize everything under FVTPL, fair value through profit and loss. Even if it is an unquoted equity investment, you need to classify that under fair value through P&L. Fair value and the fair value changes are taken to the P&L, right? But standard gives us a option. This is only an option to designate the particular equity financial asset as fair value through other comprehensive income, provided two conditions are met. What are these two conditions? Number one, the particular investment cannot help for trading purpose. You don't have any trading purpose. Okay, as well as this is a irrevocable choice available only upon the initial recognition. That means once you put this under the fair value through OCI, that decision cannot be reversed. You can't come back and say that I want to put this under the fair value through profit and loss. That is not possible. Irrevocable choice. As well as this choice is available only at the initial recognition. You have to do the designation at day one as fair value through OCI. You can't put initially under the fair value through profit and loss. After 1 month, you can't come back and put that under the fair value through OCI. If you are doing or putting or designating under failure through OCI, it has to be done on day one. And if you do it, it's an irrevocable choice, as well as you need to prove that you don't have any trading purpose of having this investment. So if these conditions are met, you can designate, it's an option. Even these two conditions are met, but still you can put this under the FVTPL, right? Because normal expectation is to put under FVTPL, right? Everything is under FVTPL, but you have a choice. If these two conditions are met, you can designate those under failure through OCI. So if you look at again the financial statements of this particular case, you see under the other comprehensive income, there's a small amount of gain or loss out of the financial assets measured under the failure through other comprehensive income, as well as you have a reserve balance. Other than the retained earnings, there's a reserve balance in the statement of financial position, right? To get these, gains accumulated, right? If you look at the balance sheet, you don't have separate reserves for revaluation, separate reserve for this particular value gain or loss. You just have one account, right? The technical name should be other components of equity. If you if you correctly prepare your statement of financial position, your equity section should comprise of share capital, retained earnings, and other components of equity. In this case, so the other components of equity should include all the other reserves other than the retained earnings. But in this particular matter, it is not mentioned as other components of equity. It is mentioned as reserves. So that is actually the other components of equity. Right. I hope you understood again. Clear? Right. So then after this, we are moving to the power sector financial statements, right? So let me finish this as well. That is also relating to the long-term assets of the organization. So now this particular company is, and even the owners, chairman wants to drive this business to improve the technology usage within the business, right? Bring automation into the business. So because of that, he advised the research team to develop what? IT-based agro application in order to bring the smart agriculture in the future and have smart supply chain within the group. Now, normally, with regard to the intangible assets, internally generated intangible assets are not recognized, like internally generated brands, internally generated copyrights, internally generated trademarks are not recorded on the balance sheet. But if the intangible assets are purchased, those are recorded. Even internally generated goodwill is not recorded. But the development of this particular application requires research and development work. You have to put an effort. Now, the instances where you have these research and development activities in terms of an internally generated intangible asset, at that time, you can recognize, even though it is internally generated, as an intangible asset in the statement of financial position. Now, so this particular app that you developed requires, effort of the people, right? You might need to have, software engineers get involved, right? Special knowledge is required. You might need to outsource it. Sometimes you have to take the people from outside. You might need to recruit people. So all these things would what? Cost you money, right? All these things would cost you money. Then with regard to the internally generated intangibles, you know this concept, research and development. What is research? Research means original and planned investigation for the new or improved scientific knowledge. So when you do the research, you don't know whether your effort would be successful or not. So because of that, the cost that you incur in the research phase, you can't capitalize, you need to charge to the P&L, right? But because here you are investigating original. For the first time, you are investigating something. But development, actually, with regard to this particular matter, I don't think that much of work to be done in the case of research, because most of the effort that you put actually under the development phase. So the development phase means application of research findings, okay, or the knowledge that you gather to develop new product, material, device, process, system, service, whatever. right? So whatever the cost that you incur in the development phase, because development phase means after doing the research, this would be successful. Now the technical feasibility is established. I can do that. It's not going to fail, more or less. So that the cost what you incur in the development phase, you can capitalize subject to, there are 6 criteria that you need to fulfill, right? So there are 6 criteria to be fulfilled, including, feasibility, enough resources are available, future economic benefits are probable, cost can be measured reliably, ability to carry out the development and complete it, intention to carry out the development and complete it. There are 6 criteria to be looked at. Normally, these 6 criteria are satisfied. If examiner is silent, you need to assume that these 6 criteria are satisfied. If the criteria are not satisfied in the development stage, he has to specifically tell you it is not satisfied. Then if the criteria are not satisfied, even the cost incurred in the development phase you expense, but subject to the satisfaction of these 6 criteria, cost what you incur in the development phase, you can capitalize. And you can capitalize all the cost what you incur before the start of the commercial production or use. Now, in this case, this particular app, before you use in the commercial production, before you use that in the agriculture activity, you can capitalize the cost. So you have to stop capitalizing the cost once you start using that in the commercial activities. So once you start the commercial activities, actually what you need to do is the capitalized development cost you need to amortize from that particular point onwards. Okay, right. So this is the diagram of, explaining the same. So the cost what you incur in the research phase, you expense. Cost what you incur in the development phase, you have to look at whether the 6 recognition criteria are fulfilled. If examiner is silent, we need to assume that it is fulfilled. If they are satisfied, capitalize as a asset. But if the recognition criteria are not satisfied, let's say even one is not satisfied, which means you can't capitalize. All 6 has to be satisfied. Let's say some of the criteria or one of the criteria is not satisfied, yet again you need to expense. But if you are not clear whether the particular expenditure is research or development, you can't segregate. So taking the prudence into account, if you are not clear, you charge the entire cost to the P&L without capitalizing anything. So as I said, development expenditure should amortize. Once you capitalize, you have a figure on the balance sheet. So this amount what you capitalize should be amortized to the profit and loss statement once the commercial production begins from the during the useful life. Okay, you have to assume that what is the useful life of the particular internally generated intangible asset. So you have to amortize it once the commercial production starts. Okay, right. Okay, that's about the development. Any questions relating to this? Any questions relating to this? Okay, right. Then we now move to the power sector, related areas. So just to check that whether Tanuja has joined. Indunil, do you need to add anything until I check that whether she has joined? If you need to add anything you can add, Indunil. 1 second, please.
No, nothing much. Dasun. Only thing is, students, as a general advice, you have to see this. All these may be, as you know, past papers. All these areas examiner cannot test, but this is a good opportunity for you to reflect upon the application of various standards. So finally, during the exam, you have to really be open-minded to look at the unseen and then to apply the knowledge. That's, I just want to reiterate that understanding. And this power sector analysis also will be very useful because there's some indication that in the case study, that area, is the area of interest. So that knowledge will be useful to you.
Right. So with regard to this particular information, again, this has been taken out of the information given in the pre-scene, right? So what it's mentioned was, as mentioned at the very beginning, at the introductory phase of the case study, right? So the company was following this acquisition strategy for the growth, but for the first time, Safeway hotel and restaurant section, or this particular company, break in the group's investment policy of acquisition and mergers. For the first time, they have invested in building a mini hydropower plant, spending 250 million rupees at a recently bought land in Haputale. They bought a land in Haputale. So in that particular land, they wanted to put up this hydropower plant, mini hydropower plant. Because there's a small waterfall. So that is what is required to generate the hydropower electricity, right? Then this mini hydropower plant was commenced in 2019. That's why if you look at the segmental reporting, you have a sector called power sector. It's not performing that great, making losses at the moment. So, but you know, it is already commissioned in 2019, generating approximately 1.5 megawatts, right? Approximately 1.5 megawatts. Then this company, Safeway Hotels and Restaurants, signed a contract with CEB. This is one of the special thing in the power sector, because who is your customer? Can company come and, you know, sell that to you and me? No, it has to be sold to Ceylon Electricity Board. So there's a contract agreement signed with CEB to sell the excess electricity after consumption by the hotel. First of all, you give it to the hotel, and the extra amount you can give it to the Ceylon Electricity Board to put that into the national grid. By hotel that is planned to be constructed in future in Haputale. But unfortunately, this hotel project was postponed due to COVID-19 and low inbound tourism in Sri Lanka. Because in the recent couple of years, we had a lot of issues. We had COVID-19, then we have this foreign currency crisis, and we had a issue in coming tourists in. So with that, actually, they postponed the decision of putting up the hotel, putting up this particular facility hotel in Haputale. But still, this power plant is commissioned and it's generating electricity. So that means it seems that now entirely you need to put it to the national grid via CEB. Okay. In addition to that, this particular information, yet again, this was highlighted by Indunil at the very beginning. So there's a director, right? Edison Senaviratna, the director who chairs the project committee. So there's a subcommittee called project committee, submitted a summary report requesting to revisit the project in Haputale. What is suggesting? Incorporating a separate private limited company. Now, earlier the decision was what? Have this power plant under Safeway Hotel and Restaurant. This under this particular company. Now, what is suggesting is to put up a separate company and incorporate a small private company to carry out this power project. Which would be headed by him, since he's an expert in the area. He's having the knowledge, having qualified in electrical and electronic engineering, and also having 20 years of work experience in the same field before accepted the independent directorship of Safeway Group. Indunil highlighted earlier, right? So once he accepts this particular role, let's say if this decision is made and he is appointed as the person who is heading this power project and the company, in that time he is losing his independency, right? He won't be considered as independent director anymore. So, but what he wants is to head that particular company. He further pointed out that due to increase in demand for the renewable energy, okay, there's an increased demand to the renewable energy as a solution to the energy crisis in Sri Lanka. I think this would be further explained in detail by Tanuja, as she's an expert in that area and she's having the relevant industry expertise for that. Right, so the growing demand for the renewable energy, this sector will do better in the future if they acquire an existing loss-making wind or solar power company. Right, so now this would be one possible area in the unseen. In the unseen, examiner might give you information about this new company, what you acquire in this sector. So where you need to have an understanding about the financials of the power sector companies, because it is different to the other businesses, power generation, right? And also I told you loss-making company means there would be a situation of you have a negative goodwill or a bargain purchase scenario, right? You buy at a lower price, your purchase consideration is less than the value of the identifiable asset of the acquired company. There's a scenario for what? Negative goodwill or a bargain purchase. So as mentioned, consolidation would be taken in my next session, because Indunil is doing a session on Thursday, right? So that is with regard to the ethics, governance, and risk aspect. I am taking my session or the second session with regard to this case study on next Sunday. There we'll discuss the consolidation in detail. So now by having this information in mind, I will hand over the session to Tanuja. So she's actually a CFA and working as the Vice President, Strategy and Investor Relations in Lakdanavi Limited, part of LTL Group, having a lot of insights into the power sector. I'll hand over the forum to her to share her views as well as to share the information about analysis of the financial statements of the power sector. Tanuja?
Yeah. Hi, good morning. I hope I'm audible.
Yeah, you are. Yes.
Yeah, thanks, Dasun. Let me just share my screen with a small presentation I made. Is this visible for you?
Yes, visible.
Okay, great. So like Dasun described, I'll just take you through a small industry overview and then look at what things you all need to be aware of in terms of revenue and cost structure of a renewable power company when you're either preparing an account set for a company or you're carrying out a financial analysis of a company engaged in renewable power generation. So starting off with the industry overview. So when it comes to the generation of electricity that we need, we have two main forms of generating electricity. So one is through renewable sources where we rely on natural sources such as hydro, wind, solar to produce electricity. And then we have the more conventional form of thermal electricity generation. There essentially we burn fossil fuels like diesel, furnace oil, gas or coal to produce the electricity that we need. So historically, if we take the power sector, most countries were relying on thermal, predominantly coal-powered plants to produce electricity that we need. But in time, there has been a global shift towards focusing more on renewable energy, mainly because of the environmental concerns relating to using fossil fuels. However, the main drawback in renewables is there are two aspects to it. One is the variability in the availability of renewable energy sources. Say, for example, if you take hydropower, the power plants can operate only if there is sufficient rainfall. And you and I are aware, even in Sri Lanka, in some years, we've experienced very drought conditions. So then we couldn't rely on hydropower generation to fulfill our demand requirements. Then again, even wind, it's very seasonal. If we take Sri Lanka, wind is available in abundance only during the months of July to September. Then solar also, of course, sun shines only during the daytime, and during rainy seasons, we don't get required level of sunshine to produce a lot of solar power. So that is one drawback. And then in terms of storage also, now if you take fossil fuels, we can keep them in storage to use it for power generation as and when required. But hydro, of course, to some extent, we can create dams and store hydro. But when it comes to wind and solar, that possibility is not available. So then the other option we have is use wind and solar and hydro when they are in they are available, and then produce electricity, and in turn store the electricity that we produce to actually consume when needed. But there again, there are lots of technical difficulties around storage of electricity. So the only viable option we right now have is battery storage. But again, the financial feasibility of it, to use batteries in a commercial scale is still not possible. So because of those inherent drawbacks in renewable energy, though even in Sri Lanka, there's a lot of discussion about significantly increasing the renewable capacity in the country. Every country needs to be mindful that we will always need to have a mix of renewable and thermal power to better manage demand and supply conditions because of the variability in the availability of these renewable energy sources. So if we look at power generation in Sri Lanka or in any other country, there are multiple parties engaged in power generation. So if you look at Sri Lanka, we have the CEB, Ceylon Electricity Board, who is actually generating power through their own power plant. So if we take Norotchole, which is the largest power plant that we have in Sri Lanka, 900 megawatts. So that's owned by the Ceylon Electricity Board. And even the large scale hydropower plants that we have like Victoria, those are also owned by the CEB. Then also we have private sector entities engaged in power generation. So they are generally called as IPPs, Independent Power Producers. So IPPs are mainly prevalent in the renewable segment of power generation in Sri Lanka. We actually have a few parties like Lagdanavi engaged in thermal power generation, but majority of the IPPs are engaged in renewable power generation, that too very small renewable power plants. So generally most of these IPPs, they have less than 10 megawatt power plants in each location. So if we move on to the actual recognition of revenue when it comes to the power sector. So revenue is mainly derived through the sale of electricity to a power utility. So power utility is the entity given the responsibility of generating, transmitting, and distributing power within a particular area. So essentially, taking the electricity generated by the power plants and distributing it up to the end consumer level, which is households, offices, factories. So the responsibility of doing that distribution lies with the power utility. So in Sri Lanka, again, CEB has a monopoly over the entire generation, transmission, and distribution aspects of power in Sri Lanka. So any company wanting to supply electricity to our national grid, they have to do it via CEB. So when it comes to revenue of a renewable power plant, it's a simple thing. Whereas in thermal power plants, it's a more complex system adopted, but I won't go into that because that's beyond the scope of your case study. So when it comes to the renewable power plants, revenue is essentially the number of units of electricity generated, which is measured in kilowatt hours, multiplied by the tariff. The tariff is essentially the rate per kilowatt hour provided by the CEB. So when it comes to identifying the revenue that a renewable power plant can or any power plant can supply to the national grid, we need to look at the agreement that has been signed, agreement or contract that has been signed between the particular power plant and the CEB to identify the key terms which in the agreement which will determine the level of revenue that a power plant can achieve. This contract or agreement in the industry is referred to as a power purchase agreement or PPA in short. So when it comes to large scale power plants, especially thermal power plants, the PPA is a very complex document. It will be a few hundred pages long document, and from one power plant to the other, the terms and structure of the PPA can change. But when it comes to renewable power plants, especially the small, less than 10 megawatt power plants, to reduce the complexity of the agreements, CEB has developed something called a standardized power purchase agreement, SPPA. So that is only signed between the power plant and the CEB, and since it's a standard document, each company will have a similar agreement with the same set of terms and conditions. So the first point for y'all when either doing a set of accounts for a power company or analyzing a power company's accounts is to take a look at the PPA or SPPA relating to that particular power plant. So in that, you need to identify what the capacity of the power plant is. So the capacity will essentially determine the output that is the contractual output that the power plant is able to provide to the national grid. And then all these PPAs or SPPAs are signed for a particular term or period of time. So only within that period of time is that particular power plant allowed to sell its electricity to the national grid. So when it comes to renewable power plants, these contracts are generally long-term, covering a period of up to 15 to 20 years. And then very important is the tariff structure. So the tariff structure can be either a fixed or variable tariff rate. So when I mean fixed, it can be a one particular tariff rate covering the entire term of the PPA. Say for example, 20 rupees per kilowatt hour. So from the very first year up to the end of the PPA term, the monthly tariff or the kilowatt hour tariff will always be at 20 rupees. Or there can be variable rates where every year the tariff rate will change based on the terms clearly set out in the SPPA. So how CEB generally comes or fixes the tariff structure for a particular power plant, they have adopted two systems. So one and the most popular system currently applied in Sri Lanka for renewable power plants is what is called as the feed-in tariff system. So there, CEB determines the price that they will offer for each type of renewable energy source. Now CEB has a lot of engineers, so based on the cost of developing different types of power plants and based on what kind of return expectations and investors will have, they determine, okay, this is the tariff that will offer for this particular type of energy source. So for hydro, there will be a different tariff rate. For wind, there will be a different tariff rate. Solar, different tariff rate. And each company entering into SPPA with the CEB will need to provide electricity to the national grid at that set tariff rate. Then the other method CEB adopts is what is called the open tender system. So in that method, CEB doesn't provide the tariff rate. They actually invite prospective parties to provide proposals with the tariff that they can provide electricity to the CEB. And then it's a competitive tender process. So the projects will be awarded to the parties which provide the most competitive tariff rate. So whether it's a feed-in tariff or an open tender system, the finalized tariff and the terms of how that tariff rate is calculated will be in the SPPA signed between the project company and the CEB. Then if you, sometimes when you analyze the accounts of power sector companies, you may come across another revenue line, which can either be called as operations and maintenance fees or management fees, or it can be both. So this happens now. Generally, what happens is the project company owns the power plant and they undertake the day-to-day running, the operations and maintenance. We refer to it as O&M. O&M activities of the power plant are undertaken by the company itself. But there are some instances where if the particular owners of the power plant don't have the required technical capabilities to undertake the operations of the power plant, they can actually outsource it to a third party company, which can be another power plant who provides these O&M services to third party power plant. Say, for example, I am an investor. I'm looking at investing in a power plant. I have the required funds to invest in the power plant, but I am not an engineer and I don't have a team of engineers to advise me on the running of the power plant. So in that case, I don't need to completely not invest in a power plant. I can still invest and then through a contractual agreement, hand over the actual O&M of the power plant to a third party company. So if such an arrangement is in place, again, the terms of the fees charged and the terms of the scope of work undertaken by the power plant owner and the O&M contract are governed through contract signed. So it's generally called as an O&M agreement. So in that, again, the fee structure relating to the O&M activities can either be a fixed monthly charge or it can even be a variable charge depending on the actual electricity generated by the power plant, or sometimes it can even be a mix of a fixed and a variable rate. And then the term of the agreement, sometimes the agreement can be signed to cover the entire period of the underlying PPA of the power plant, or it can even be signed for a shorter time duration with the option of renewals. So if there is such an arrangement in the respective power plant that you are analyzing, then in addition to the SPPA, this O&M agreement is also another document you need to definitely look at to identify what kind of cost structure and what kind of fees that would be applicable for the power plant. So again, just to reiterate, when there is an O&M contract signed, the agreement will specifically provide what are the responsibilities of each party, the owner as well as the O&M contractor, in undertaking the O&M activities of the power plant. So the costs that each party would have to bear would depend on the scope that each party will have to undertake in the O&M activities. Then looking at the general cost structure of a renewable power plant. So in terms of direct expenses, like I said, the operations and maintenance activities, the costs incurred in operating and maintaining or running the power plant on a daily basis will be included as direct expenses. So if the power plant, the company itself is carrying out the O&M activities, then they will need to engage engineers and technicians to undertake the operations and maintenance aspects of the power plant. So then you will have staff costs relating to the engagement of these professionals. Then, you know, a power plant is a set of machines. So there can be breakdowns, there can be regular maintenance that is needed to ensure that the power plant operates at its optimal level. So you need to have spare parts, you need to undertake maintenance activities. So you will have to incur expenses for all these different areas. It's like owning a vehicle. So if you own a vehicle, you need to do your regular service. And then if there is a breakdown in the vehicle, you need to rectify it so that you can drive the car again. So the power plant is a similar thing. You need to undertake regular maintenance, and if there are breakdowns, you need to undertake emergency maintenance and recoveries to ensure that the power plant can continue to generate electricity and generate revenue to the company. Then, because the power plant costs hundreds of millions of rupees, you need to ensure that you have adequate insurance coverage in the event that something happens to the power plant. So there is a annual insurance payment you will need to maintain to ensure that the insurance premiums are available for the power plant throughout the term of the PPA. Then, if the power plant is not built in your own land, if you're using leased land, then you will have to incur lease payments. So in some of the power plants we see, since the PPA is for a very long term, the leases on the underlying land the power plant is constructed is also through a long-term lease agreement. And then most of the project companies pay upfront the lease for the entire term of the lease agreement, and then over the years of operations, that lease expense is amortized to the P&L. Then in addition to you providing electricity for the national grid, the power plant will also need to incur or need electricity to undertake the day-to-day function. So there will be electricity cost involved. And then the main cost item that a power plant entity will have is the depreciation. Like I said, it's a sufficient initial investment you need to incur to build a power plant. So that cost will be depreciated over the life of the PPA. Then, like I said earlier, if there's a O&M arrangement, if a third party is going to undertake the O&M activities of the power plant, then there will be a O&M fee paid to the O&M contractor. So that will also be reflected in your direct costs. And then under the scope of the O&M agreement, the cost that the power plant incurs for the operations of the power plant will also come under direct expenses. So just to look at the practical application of what I just discussed, I thought I will take you through the latest annual report of WindForce. But before that, can I just ask if anybody has questions or clarifications needed on what we discussed up to now? Dasun, any questions?
Yeah, I don't have any questions. So basically, it's clear because the operations are different to a normal business operation in terms of the power plant, because your balance sheet consists of a huge amount of fixed assets, especially the power plant construction. Then your revenue mainly consists of the power generation, plus there can be a revenue item if you are providing operational and the maintenance services to the others. And as Tanuja mentioned, like most of the time, the land is a lease land, so that has to be recognized as a right of use asset. And if the payments are made upfront for the entire amount, you recognize the entire amount. You need to just amortize that over the useful life in the sense during the lease period. But if the payments are made on annual basis, what we do is we have recognized the right of use the asset and the lease liability in the books as per SLFRS 16 and account accordingly. But as she mentioned correctly, most of the times companies are paying the entire lease payments upfront. So then you don't have a liability, you just have the right of use the asset, capitalize it and amortize it over the period of time. That is just for the explanation. That is actually kind of clarification for the doubts in terms of the accounting that you might have. Right, you can continue, Tanuja.
So we can actually see these line items when we look at the WindForce annual report. Let me just share that. This is the latest annual report prepared by Winforce PLC for the financial year 2022. If I just go to page number 7, so here, like I said, Winforce is the largest renewable power company in Sri Lanka. They are predominantly in the wind power space, but they have diversified their operations to include ground and rooftop solar, as well as mini hydro power plants. And what we need to be proud of is their power plants are not just in Sri Lanka, but they also have power plants in overseas markets like Pakistan, Uganda, and Ukraine. And they are continuing to explore new opportunities in other global countries as well. So if I move on to page 66, so that will show us the scale of the operation. So here they have put out a table specifying the power plants and installed capacities that they have under each of the different renewable energy sources. So they have their wind power plants, which are purely in Sri Lanka. And I think they have about 50, 60, 70 megawatts of installed capacity when it comes to wind power plants. Then they also have solar power plants in Sri Lanka as well as overseas markets like Pakistan and Uganda and Ukraine. And they also have hydropower plants in Uganda as well as different locations within Sri Lanka. So if we total all of these different power plants that they have, their total installed capacity at the moment exceeds 200 megawatts. Then, like I said, now the ability to generate electricity and recognize revenue is there with the power plants only within the term of the PPA sign. So the PPA term, 15 years or 20 years, starts from the date that the power plant is commissioned and is connected with the national grid. So that is a very important number or information that you need to be aware of when you're looking at a power plant. So that is why even in the annual report for each power plant, they have specified what the date of commissioning is, and then based on the date of commissioning, what is the remaining life of the PPAs in each of these power plants. So now when you look at a normal company, the normal principle is you assume that the entity or company has a very long undefined future life. But that same assumption we cannot use for a renewable power company, because the ability to conduct operations is purely dependent on the remaining PPA terms of the power plants that the company owns. So in order for a power plant to ensure they also have indefinite life, they need to continue to bring in new power plants into operation and extend the remaining PPA term of the power plants. So when you're analyzing this, the PPA years left is also a very important set of information you need to look at, especially now. I think your case talks about acquiring new hydro and wind power plants. So I mean, acquiring a power plant which has a remaining term of 2 to 3 years won't make sense. So you will need to ensure that the power plants that the company acquires has a reasonable time period left, and especially if they are loss making now, it has to operate for a reasonable time period to enable it to generate profits and provide a return on investment. So again, this is something you need to be aware of. And then they have given an estimate of the annual generation of electricity that each of these power plants can expect. So I told you the basic measure of a unit of electricity is kilowatt hours. So 1000 kilowatt hours equals 1 megawatt hour. and 1000 megawatt hours equals 1 gigawatt hour. So they have presented the electricity generation in gigawatt hour terms. So you need to be aware of this measure when you're analyzing numbers relating to energy generation. Then now plant load factor. That is another common terminology that you will hear or read about when looking at power sector companies. So now installed capacity is essentially the maximum output that the machines can produce. It's like the capacity of a normal plant or equipment that we use in a factory. But you must be more familiar with capacity utilization. So that is out of the total capacity install of the equipment, how much we actually use. So plant load factor is a similar measure. So a plant load factor is determined by different aspects, and when it comes to renewable power plants, it's mainly determined by 4 criteria. So one is, like I told you earlier, the availability of the energy source. So that has a big impact on the actual plant factor that a power plant can generate. And if you take a power plant and evaluate the generation over a period of time, you may come across big fluctuations in this plant factor that can be predominantly based on the availability of the energy source. So for example, if you take a 5-year period and analyze a hydropower plant, there can be 1 or 2 years that the plant factor has significantly dropped. So then if you go to analyze why it had happened, it may be because in those particular 2 years, there was a severe drought in the country. Or then even in solar power plants, there can be years that the plant factor is low. In those years, it may have been that there was heavy rainfall in those particular years. So the availability of the energy source has a big impact on the plant factor. Then the second important aspect is the quality of the installed equipment. So no matter what the capacity of the machinery is, if the plant isn't designed in a good manner and the equipment is of high quality, you cannot generate a reasonable plant factor. Then the third one is if the plant has certain breakdowns, then also you can't use the machine, though it's available, you can't use the machine to generate electricity. So that also impacts the plant factor. And finally, this is a risk that is inherent in renewable power plants. It is the issues in the national grid. Say no matter how much the power plant produces electricity, for a issue with CEB, if CEB is unable to get the power generated into the national grid, then as per the terms of the SPPA, CEB is not obligated to pay the tariff for the power generated. So we even Winforce and even Lagdana, we experienced this issue practically about 2 years back. So the CEB transformer in the Puttalam, Kalpiti area where the wind power plants are situated, CEB, there was a big breakdown in the CEB transformer. So because of that, for over a year, these power plants were not able to supply the electricity to the national grid. So if you look at those particular years, there's a significant drop in revenue. So yeah, then just moving down, go to page number 136. So this is essentially the format of the income statement. It's like the standard format that we see in any company. So we will look at what comprises of this revenue and direct costs in the notes that they have specified. And like Dasun said earlier, the main asset in any power plant would be the property, plant and equipment, which is essentially the cost of development of the power plant. And the other key asset item would be the receivables that are due from CAB. So if you look at the industry right now, due to the difficulties that the CAB is facing, all the renewable power companies are facing or having receivables of more than 1 year in their books. So, I mean, if you look at this particular figure, will be very high across all power sector companies at the moment. And then going down to the...
Sorry, Tanuja, may I ask a question on that, Indunil?
Yes.
Now, because this company is going to acquire, expand more into this business, what the future looks like in terms of recovery? There is a business risk. If they invest, there
Yeah.
will be recovery issues. So, what is your view?
So the positive side of it is, in the history of CB, they have never defaulted on a single payment to IPPs. There have been, of course, delays, but never a default. Also now, as you all are aware, there was an increase in the tariff that CB charges from their consumers. So that happened in mid-August, and CB is getting a higher cash inflow from the month of October, November onwards through this tariff increase. So with that, CB's intention is maybe from January onwards next year, they will clear all these outstanding payments to the IPPs. But the negative side is now now the thermal power plants in Sri Lanka and some of the offshore renewable power plants, the PPAs have a term where if there is a delay in receiving the payments from the power utility, the power plant can charge a liquidator damage for the late payment. But unfortunately for the IPPs in the renewable sector in Sri Lanka, that condition isn't there. So when there are delays in payment receipts, the entities have to fund that cash flow constraints or working capital constraints through bank borrowings at very high interest rates. So because of that, most companies are facing issues. So that's why at industry level, there's a lot of lobbying with the CB to quickly clear these payments.
Yeah, thanks, Tanuja, because that's a big point for students. When you analyze the case study, you see these guys explicitly say they are in a cash crunch. And now in that context, invest in more as a more business risk, just for the case information.
Yes, so I think before making the final decision on the acquisition, the company will need to have a clear idea on the CAB stance and the ability of the power plants to obtain bank financing to manage the working capital situations till the CAB receipts are available again.
Yeah, so that's a good risk mitigation. So please note those are important board discussions, students, even from governance angle. Also, Tanuja, there's a question to chat about the depreciation whether it's commission at the start. Depreciation start from the commission date and is based on the unit generated, though useful lifetime of the power plant based on the PPA term.
So the depreciation is based on the term of the PPA. It's on a straight line basis, depending on the term of the PPA.
And start at the commission time.
Start at the commission, yeah, first year of operations.
So this, I think, in the case study, they have commission 2019, if I'm not mistaken. Yeah, so from that day is to be...
Yeah,
yeah,
2019 onwards.
Sometimes some companies say the useful life of the power plant is 30 years, whereas the PPA is 20 years. Some companies we see taking the useful life and depreciating it over 30 years as well. So it depends company to company. I think best course of action would be to depreciate it during the PPA term.
Yeah.
Why some companies use the actual useful life is we've seen the CAB renewing some of the PPAs that were expired. So if the power plant can actually operate for more than the initial PPA term, there's the probability of it getting extended. So some companies that went for a renewal of the power plant had to reclassify depreciation so that they can depreciate the power plant over the new PPA term. There were issues like that also.
Yeah, those are very important point when they acquire a new company, how they have applied depreciation, things like that. No?
Yeah.
There is a related question on the CEB after restructuring, whether it's possible to recover all that is uncertain. You can also share your views.
Yeah, I mean, it's too early to say anything because there's no exact plan on the restructuring. But I mean, what we need to be aware of as a country and the CAB, there's a lot of pressure to increase the renewable energy capacity in Sri Lanka because right now we are producing electricity more from thermal fossil fuel based power plants. So in that context, whether CAB will want to default on any payments to the existing power plants is highly unlikely because that will prevent a lot of new parties from coming into the sector. So they will not want to do that, but will somehow manage these cash flow because in an overall context, looking at the total CAB cash flow, what is due to the IPPs in the renewable sector is quite insignificant. So if they manage their cash flows properly, paying this will not be a problem in the medium term. And I think they are discussing about another tariff increase as well. Because the tariff increase that they got in August wasn't the exact tariff increase that CB required to ensure that their financial position is positive. So in the coming months, we expect another tariff revision to take place. So looking at the, can I move on?
Yeah, sure.
Sorry, Dasun, just now for in this case study, Tanaja, given the in terms of fundraising and going for this investment, kind of what are there any alternatives from risk management angle for them to engage? Like they have a cash crisis situation, and obviously there will be delay in collecting, even if they were to go for this investment.
Yeah.
And that looking at Dasun, what do you think about the I think liability side already they have raised some loans, right? Just from
Yeah.
overall angle, what do you think? What alternative options for them to fund? Is there anything you can add? Then students will have very strategic understanding of the case.
So I mean, the current economic context is the best conducive time for investment because if you see now interest rates are more than 30%, but no company can generate a return of 30% or more. Like most of the SPPAs signed in the recent past, they were with a equity return of about 15 to 18, maximum 20%. So funding that acquiring a project at 30% interest rates will not generate a required level of return. And then even in terms of relying on bank funding, now banks are also facing a lot of difficulties because their loans aren't getting repaid since EAB is not paying the due amounts to the power plants. So banks are also, I think some banks they've taken policy decisions not to lend to the power sector till these issues are sorted out. So like that, I mean, if the company can get a bargain price, best course of action would be to use equity and not expect a 35% return, but have a long-term return expectation of about 15-18% when making investment decisions.
It's possible for them to go to public and raise funds. They are already a listed company. That's something setting up another company or
Yeah, so that also depends on the confidence of the public. Now, it's a common knowledge that these IPPs aren't getting repaid. So, because of that risk and because of the CB getting restructured, the concern is whether the public will have enough confidence to invest in a company that is going for more investment in power plant. So, for example, even the company I'm working for was actually looking at going for a public listing this year, but we also decided to postpone it till all these macro issues are sorted out. I think even across the board, most of the power sector company share prices have also come down. So those are also concerns in going for public fundraising at this point in time.
Sure, thank you very much. Students, I mean, these are overall very good for you to have that understanding. I'm sure it will be helpful in different papers, not only this, but even from this case study angle, it will be useful. There are, I think, few questions to chat also. That's about challenges of power plant industry other than the renewable sources and who is the governing body of power plant sector. Are the ISO standard mandatory to comply, etc.?
Yeah, so the Public Utilities Commission, PUCSL, so that is the governing body. So any power plant that is supplying power to the national grid has to get a license from them. And Sustainable Energy Authority is also involved in renewable power projects in the country. But always the contract, the PPA that you sign will be with the CEB. So CEB, in order to get the power plant interconnected with the national grid, they will need the power plant to obtain the required approvals and licenses from these government entities. There are environmental approvals you need to get depending on the location of the power plant. There can be wildlife related approvals you need to get. So all that will depend on the location of the power plant. So what was the other question asked?
No, I mean, that's a related one. They're asking me the challenges you covered there. No, who is the governing body also you answered, no? So yeah, that covers.
PUCSL is the governing body of the power sector. That's why you always see the PUCSL chairman coming and talking about how much that the CEB can increase tariff, how many hours per day the power cut CEB can get. So those kind of things are decided by the PUCSL. Even the future power generation capacity that the country needs to install, what kind of energy sources that the country needs to adopt to increase this install capacity, those also so the CB only evaluates and identifies those aspects, but CB needs to get the approval of the PUCSL before implementing those actions.
Yeah, you can continue.
Yeah. So coming back to the windfall, so if you look at the revenue recognition policy, so you will see supply of energy. So supply of energy is recognized upon delivery of energy to the CEB. The electricity units generated are measured by other metering equipment located at each power plant. The title of the energy output shall transfer to the CEB at the metering point. So essentially, from the power plant, there will be something called interconnection point. So from the power plant, the power producer has to transmit the power produced to the interconnection point. So at that point, there will be a meter which is owned by CEB, which will calculate the number of units of electricity produced. And at that, and the meter reading will only determine the revenue that the power plant can obtain each month. So after that particular metering point, the responsibility of transmitting and distributing that electricity lies with the CEB. So our obligation is to get the electricity generated up to that interconnection point.
Adding one more thing there, that is the point where, as per the standard SLFRS 15, control is passed, because you have to recognize the revenue at the point where the control is passed. So as Tanuja mentioned, at the particular point, metering point, control is passed from the company to CEB.
Yeah, I will ask one related thing from both Tanuja and Dasun can comment. If you look at this company, very unusual numbers now. They say they have started something. There is, and initially I think they are providing to their own restaurant or a hotel, I guess. So there is revenue of same amount and intercompany. They have put the same like the full revenue as intercompany revenue, just 96 million, and that there is somewhere they have mentioned that other expenses, that's all given. So in a context like that, I think it's about they say it's commission, but this revenue can be external revenue, right? This full amount is mentioned as Dasun. Did you notice that in the segmental report in section, the full revenue is coming from intercompany, sorry, intersegment, right?
One second.
Yeah, if you go to the power sector,
entire 96.
Yes, that is say revenue 96.
Probably, Indunil, that is because now it's mentioned in the particular information. First of all, they supply to the hotel, and thereafter only for the national grid. But unfortunately, hotel was not constructed. So might have been they supply this electricity to someone else in the group, as they are not supplying to the hotel. You know, so that would be the reason, because otherwise, if it is to the government, that's not going to be intercompany. Your you know, like finding is correct.
Yeah, something also they are say instead of net income, there is a negative figure 400 million, some other cost maybe. But those are with
that would be the operational cost, right? That is after gross profit, because what they mention is revenue minus cost of sales. Then you calculate the gross profit. This is actually other operating expenditure, like administration expenditure. So that would be the negative point there.
Net other income or expenses. Yeah. It's not, it's all that accounts looks really unusual. You know, it's same amount mentioned both revenue and so just apply your knowledge to talk about it. I mean, whatever you learn here, and if they give in unseen more information, this knowledge will be very useful for you to analyze. Right.
Even in a practical sense, that arrangement is very unusual.
Yeah, that's the thing. Same amount and it says 0 actually. So 96, 96.
And as far as I'm aware, a power plant can not enter into an agreement to supply electricity to another party. It has to be to the CEB. So it's a little unusual, yeah.
Because when they say commission, you have to first produce to the supply to the CEB, right? So only excess you can utilize. That's the way it works, right? Am I correct?
Dasun, sir?
Yeah.
Hello. It can be management fees, right?
It can be management fees, yes. So what you are saying is power plant management fee to whom is the question? Because what Tanuja mentioned was as the management fee earlier to another power plant. Did you get my point?
Yes, yes.
Because let's say I have a power plant, right? And I have the staff to do that, right? But someone else, he just have a power plant, he doesn't have the staff. I manage on behalf of him. Then I can charge a management fee from that outside party. You got what I said?
Yes, yes.
So then again, it's not intercompany. Yeah. And even like going into detail, if you look at the accounts, even now, normally I'm talking about not the accounts of WinForce, but the accounts what is given in our case analysis. Normally at the group level, you don't have any related party balances, right? So when it comes to the related party amount receivable and payable can be there in the company level, but not at the group level. At the group level, what we can have is only the receivables and the payable to the associate companies. So those are related parties, no. But if you look at the financial statements given in this particular pre-scene, right? So you have amount due from related parties and amount payable to the related parties at the group level. So only thing what can it, because when it comes to the parent and the subsidiaries, it's getting set off, right, at the consolidation level. And the given pre-scene, you don't have any associates, what is accounted under equity method. And also you can have a receivable or payable at the group level if there are receivable or payable with the key management personnel of the entity. Now, so yet again, so such information is not given in terms of these related party transactions. So anyway, about that, I will discuss in detail in the next session where we to cover the financial statement, segmental analysis, as well as the consolidation, plus few more areas of the session or the accounting standards, which I will deep dive in the future sessions.
Okay, sir. Thank
If
you.
you don't understand at this moment, doesn't matter, right? Because without showing the financials, I have just explained, having the assumption that you all went through, but it doesn't matter. I will explain about this in detail in the next session.
Oh, thank you, sir. Excuse me, Miss Tanuja.
Yes.
Yeah, what do you mean by the commission date?
So that is the date that the power plant has finished construction and it's ready to generate power. So that's the first day of operations essentially.
You should start depreciation from that date, right?
Yes.
That
And
means
the PPA term also starts from that date.
That means it is available for use from that date, commission date.
Yeah. So what happens is the PPA is signed with the Ceylon Electricity Board before the power plant is constructed. So say it takes a year to construct. So the commissioning date will be 1 year afterwards. So though the PPA is signed 1 year before, the PPA's term will start from the date it was commissioned.
Okay, got it. Thank you.
So that is, so the commissioning date, you will need to specifically get it from the management, because if you read the PPA, the commissioning date won't be specifically mentioned. It's only the PPA signing date that will be there.
Yeah, that we should start depreciating from commission date, no?
Yes.
Yeah, okay. Not from the PPA sign date, no?
Not from the PPA sign date, but from the actual date of commission.
Commission, okay. Okay, thank you.
Yeah, so I mean, coming back to this case, since they seem to be providing electricity to another company within outside the group, then similar to the PPA, the company needs to have an agreement with this other party as well, which will set out the number of units of electricity that they can provide, as well as the tariff relating to the supply of electricity. So coming back to the WinForce account, so this is what the revenue note looks like. So their main revenue item is coming from the supply of electricity. Now you will see when it comes to WinForce PLC company level, there is 0 revenue, but all the revenue is coming under group revenue. That is because if we take Windforce PLC as a company, they seem to be only an investment holding entity, and all the power plants coming under the group are as separate SPVs. So again, this is a requirement of the CEB, say you cannot have two SPPA signed by the same entity. So for each SPPA or new power plant that a company puts out, they have to form a new SPV specific only for that power plant. And most of the power plants are BOI entities. So as per the regulations of the BOI, to get BOI status, also that particular power plant has to be formed as a separate entity. Then now looks like Windforce, in addition to owning and operating their own power plants, which is providing them revenue through the supply of electricity, they have both management fees and O&M fees. And if you look at company level, these fees are high, but those have come down when it comes to group level. So what seems to be happening is now when a particular power company has a lot of power plants, the O&M activities are done centrally so that there are cost efficiencies. So looks like Windforce PLC is undertaking the O&M activities of all group companies. So at company level, they are recognizing high O&M and management fees. But when it comes to group level, those intercompany revenues are excluded, and only the revenue accruing from O&M services provided for companies outside the Windforce group are coming under group revenue. Any questions on this? Yeah, if not, I'll go down. Yeah.
There's a question whether there'll be another compared to the group. Yeah, it would be most likely a scenario in the unseen where a new company would be acquired. That acquisition would be given and you can see the financials of that company in the unseen. That is one possible scenario. Yeah. Okay, Tanuja, you can go ahead.
So coming down to the direct cost note. So like we explained, the main cost item of a power plant would be the depreciation of the power plant during the PPA term or the useful life of the power plant, whichever the company chooses to adopt. And then we have the O&M costs that the power plants are incurring in running the power plants on a day-to-day basis. Then, like we discussed, all the power plants have to maintain their insurance policies for which there will be annual insurance cost. Then on any repairs and maintenance undertaken, there will be costs involved, which is separately categorized and shown. So those are the main cost items coming in any power plant set of accounts. And like we said, with regard to the land, so they also seem to be leasing the land required for the power plants and seem to have paid upfront the total lease payment and then amortizing that cost over the period of the lease agreements. Then just to show you all the other operating income note. So looks like Windforce, even the interest, dividends, unit trust income that they generate are classified under other operating income. Other than that, in relation to the co-operations, so this particular line item is there, income from liquidity damages. So that is coming from what I explained earlier. So seems like for some of the overseas power plants, in the case there are delays in the payment of invoices, Windforce is able to charge a liquidated or late payment interest from the utility. So that is also coming as a separate income line for the group. Then income from carbon credits. Now, you know, a main benefit of renewable power generation is the environmental impact of it. So the carbon credits that are generated through renewable energy, those can be sold to other parties. So when it comes to Sri Lanka, that benefit isn't given to the IPPs. I think the carbon credits belong to the CEB and the government of Sri Lanka, but seems like in some of the overseas operations that Windforce has, they are actually able to sell carbon credits and recognize that also as a separate income line.
Excuse me, Ms. Tanuja.
Yes.
Yeah, that income from liquidity damages only relevant to the thermal energy, no? Not relevant to the renewable, no?
So in Sri
As you
Lanka,
mentioned.
yeah, in Sri Lanka, liquidated damages are not available in the current SPPAs, but now
Yeah.
Windforce has power plants in overseas countries now. So in
Yeah.
those countries, they must be able to claim liquidated damages. So that's why this income is there in the set of accounts.
Okay, thank you very much.
That's about it from
Ms.
me.
Tanuja,
Yeah.
is there any decommissioning cost? Yeah, is there any
It will depend, but it is not a cost that you can predict and bring it into the books during the period of operations. So that is generally not a cost item that we see in a power plant.
Let me take that question actually from accounting perspective. Why this question was asked is, when you are capitalizing the PP&E, when you take the initial measurement of a PP&E, so the items, one item, it can be capitalized is the present value of estimated dismantling and site removing cost. Now, let's say the power plant period is 20 years. So in that case, what you need to do is you need to estimate how much of cost that you need to incur after 20 years decommissioning, get the present value. That particular present value you need to include as a part of cost of property, plant and equipment, debit PP&E and credit to a provision account, right? Then that particular amount, what is included within the power plant cost, is getting depreciated over the term of the PPA or the power purchase agreement. And the provision amount, what you created, would be getting unwound each year up until the 20 years time. So that's the accounting treatment for if you have any decommissioning cost in terms of the particular power plant. I hope it's clear.
Yeah, sir. Yes. Yes, sir. Yes. That means in
Great.
some situations, like Ms. Tanu just said, there is no decommissioning cost. No, we cannot predict that thing. So in some financial statements, sometimes there will not be any decommissioning cost provision, right, sir?
Exactly. It's depending. It's actually specific to the particular power plant. Now, sometimes when it comes to renewable, the decommissioning cost would be less comparing to non-renewable, like thermal or coal power plant. So there you might not have any amount what you capitalized as present value of the decommissioning cost. But definitely in the exam, if there's any decommissioning cost, in the unseen, it would be specifically mentioned for you all to take the decision. If it is mentioned, that has to be incurred. Accounting treatment is as I mentioned earlier. Is that clear?
Yes, sir. Yes. Thank you, sir. Thank you.
Okay. Right. So I think that's it. Tanuja, anything else?
No, that's about it from me.
Right. So students, it took bit of, so first of all, thank you very much, Tanuja, adding the insights, giving the overview about the industry and explaining the financial statements of the power sector. So I think we took little, actually close to 1 hour, more than the scheduled time, but hope these insights are useful to you. So what we do is we need to continue with the remaining part of the presentation, targeting the accounting standards, plus most important area of consolidation next week. That means next Sunday, At the same time, I'll meet you and discuss about those areas. And by the time being, Indunil would conduct a session during the week. So this week is entirely for the analysis of pre-scene with regard to the governance and ethics aspect of the pre-scene. So in addition to that, like now in the revision module, a lot of recorded videos are uploaded into the revision module. In addition to the pre-scene analysis, please focus on the videos and the areas uploaded in the revision module for you to successfully complete the examination this time in terms of the SL1. Okay, so with that note, we'll make a conclusion for the session today. I'll see you next week to continue with this discussion. So if you need any clarifications, you can ask, or else you can give your views about the session. That is helpful for us to, when planning the next couple of sessions with regard to this pre-scene analysis. Okay, stay safe and bye.